right, afternoon, everybody. What a great start. I hope you guys are having a great day so far. Welcome to the second Outcome Matters event for the year, the first hybrid one. So everything's live. Everything's going to happen live, as all the mistakes tend to. Welcome, everybody. My name is Andile Jonas, and I'll be hosting you for the duration of the session today. All right, so before we kick off, I just want to get some housekeeping in order. But before that even, I also want to welcome our virtual audience. They are watching from the comfort of their own homes on their screens. Hello, everybody at home. Just some housekeeping for the people in the room. If you are not aware yet, the bathrooms, as you walk out the door, keep to your left, go around the wall, keep it on your left shoulder. Ladies, then the gents first. Francois, it's the ladies first, and then the gents. We don't want that other incident to happen again. Another bit of housekeeping. We've applied for CPD points for the session. There's 1.5 CPD points for today's session. Very, very important that you know that. And for those of you that are in the room, you have a virtue card that you got as you arrived. Please make sure that you've scanned that virtue card as you come in and that you scan it when you leave. That is how you will redeem those CPD points. If you haven't scanned it coming in, I'm going to allow you to sheepishly sneak out of the room so you can quickly go scan it. Otherwise, you will not get your points. For those of you that are virtual, guys, please make sure that you add your ID number to the CPD section so that we can verify your attendance. Okay. CPD certificates will also be mailed to you once the FPI has the accreditation is finalized. All right, so CPD points, tick. For those of you that are in the room, we've decided to make this event very personal because, as you all know, investing with us is very personal. So if you've got any questions, our speakers today are going to be with us for the remainder of the afternoon. They're going to be joining us in the room next door after the event is done. And we have a gin tasting. Yes, we've got a gin tasting. The investment guys have dug deep into their pockets and got out the good stuff today. For those of you at home, you're going to have to raid your own liquor cabinet today. But we do look forward to seeing you at future live events. All right, we have a fabulous afternoon ahead of us, ladies and gentlemen, and I hope you enjoy all the presentations. All right, so please take the opportunity to join us afterwards for that free booze and snacks. It's not every day you get to have free booze and snacks. I, for sure, am looking forward to it. All right, so what an incredible year so far. Hey? It's been an incredible year. Now, if you listen to the news at all, you will have heard a lot about inflation. And those of you who are aspiring chefs will know that the price of cooking oil has soared through the roof. Hey? Soared through the roof. I know, I hear it. My wife complains about it a lot. So I said to her, I saw a meme the other day on Facebook. And it actually made me laugh out loud. It's a guy who's got an air fryer, and it's a little pose, a little very, very snooty pose looking at all those other people who don't own air fryers. So my advice to all of you is to buy air fryers. That's the long and short of that story. All right. There's higher interest rates. Our economists, incidentally, say that this was the fastest pace interest rate hike in decades. The fastest pace interest rate hike in decades. Friends, you're going to have to wait until you buy that Ferrari. You're going to have to wait a couple of maybe months, quarters, maybe even decades. I don't know. You're going to have to wait a little bit. But amid everything, our markets have showed a positive start to the second half of the year. But I'll leave that to the experts during the course of our presentation today to unpack. As per our standard feedback, we will provide you with a brief economic overview and fund positioning from our portfolio managers regarding our MFP Houseview solutions. We trust that you will continue to support us as we share information that will assist you and your investment advice value proposition, your conversations with all of your clients. Okay, first up, I'm going to introduce a man that you are all familiar with. His name is Dani van der Berg. He's the CEO of MFP. Please give him a round of applause.
Thanks, Andile. We all know Andile is a man of few words. So the brief was actually that I welcome you. He's done everything. He's even actually given an economic overview already, which I wanted to do. So, Andile, and also I was briefed to actually welcome, the people who don't put up on makeup and at home. So anyway, big welcome to you. But I think the greatest, is like just to see warm bodies again. Wow, isn't it amazing? Check the nod. I mean, we missed each other, and we just need to be together. And especially in these times of turmoil. I mean, there's been so many almost supposedly bad news coming your way. And not that today is necessarily the best news, but we're giving you the best we can. Why? Because what matters to you matters to us. What matters to your client matters to us. That is actually the spirit of Outcome Matters. Because the outcome of the clients are what is important. And that is what we focus on. And I actually want to thank the investment team. I mean, your obsession with getting this right and supporting our advisors in their advice journey with the clients is actually phenomenal. And I just want to thank the investment house for your amazing commitment. And really, I mean, and today you will actually see a lot of insights, even hindsights. I mean, we all know hindsight is the best thing, the wisdom that everybody has. Look at the performance. And even insights, even maybe oversights. I mean, you can make remarks afterwards on the oversights. But just listen and engage and listen to them in terms of how and well they're equipped to give you the ammo to actually go and actually position how you give advice in this difficult times. Thank you very much once again for Investment House. And thank you very much for being here. It is so nice. And my gin, it's going to be lekker having a gin with you. Thank you.
It's always going to be tough following me, Donnie. Get used to it. Can we give Donnie another round of applause, guys? I don't recall a time Donnie's gone up on stage and not left a group of people feeling more inspired, a little bit more human, a little bit more, engaged. So thank you very much for those words, Donnie. Next up, however, is Momentum's very own Sanisha Pakrasamy. She is going to be giving us, and I'm not going to do your whole speech for you, Sanisha, I promise. She's going to give us a global and local macroeconomic outlook against a backdrop of turbulent market conditions. It's a tough one, but she's up for it. Give her a hand, please.
So I heard free booze. And as an economist, I was taught there is no such thing as a free lunch, so that's quite exciting. Welcome to everyone who was able to make it here today in person. It is really nice to see faces. I know it's the third time that someone has said this, but it's a very different feel than just presenting to a screen. And to those who weren't able to be in person, thank you so much for joining us virtually online, and I hope you take away something from today's experience as well. Now, it has been an extremely volatile, turbulent time in markets. We have seen a lot of unrest in a number of countries. We've seen volatility in financial markets, in asset classes playing out. And we've experienced what we call overlapping crises. Not too long ago, about 2.5 years ago, investors were extremely concerned about COVID-19 and a number of dangerous and scary variants that would cause economic lockdowns to take place. This was seen as the #1 tail risk to financial markets. Now we've seen more crises unfolding since then, and as a result, the COVID-19 threat to global financial markets has been displaced by a number of other issues, such as high inflation that was alluded to earlier on today. If we look at this chart, you can see that soon after the COVID-19 crisis broke out, we had seen global supply chains starting to settle once again. And just as we got used to that kind of environment, we then had Russia invading Ukraine at the back end of February. This just added another layer of complexity in commodity markets and further pushed up what we see as a symptom of supply and demand pressures in the economy. It pushed up inflation. On the back of high elevated inflation, we then saw central banks becoming very hawkish and talking about raising rates to the extent to bring in inflation and to protect credibility of the institutions out there. As a result of that, we then saw global investors becoming very worried about the global tightening in financial conditions. And as a result, we've seen recession in almost every single newspaper of late. So looking at this chart, you can see more recently, global fund managers are now worried about inflation remaining high. They're worried about central banks becoming even more hawkish to combat high and rising inflation. And as a result, they're worried about the global economy tipping into a so-called recession. Now, I showed you that the Russian invasion of Ukraine is no longer seen to be one of the major risks to financial markets. This doesn't mean that investors are not worried about it anymore. In my mind, I think investors are now becoming comfortable with the fact that the Russian invasion of Ukraine is going to be playing out in the background for some time. This means that we have now entered an era of what the IMF calls geopolitical fragmentation. This means that we are in an era of higher uncertainty. This is going to add to volatility in markets, and it's going to keep an element of risk out there for longer. Now, in line of Russia's invasion of Ukraine, the economist has pointed out that any type of conflict like this in the past has tended to be relatively short-lived. However, we've now entered the 6th month of the invasion, and looking at things today, it doesn't seem like it's going to draw to a close anytime soon. As a result, we think this is going to play out for some time in financial markets. This chart shows us that a number of developed market economies imposed very heavy economic sanctions on the Russian economy. However, the Russian economy seems to be plodding along just fine. We know that in the oil market, revenues have actually continued to bankroll their invasion into Ukraine. This is not to say that the economic sanctions are not going to take a hold at some point. These economic sanctions have been designed to economically weaken Russia over time. So while we may not see any economic fallout right now, further down the line, we are expecting the Russian economy to be on a much weaker economic footing than would have been the case if they did not invade Ukraine. Very similarly, we also saw the first Russian default in over a century on their foreign debt. Now, we didn't see any major backlash following that event, but just like a bad debt rating hangs over people, we are likely to see this playing out in the future. When the Russian economy is under a significant amount of stress and they are looking towards international capital markets to raise funds or to get external borrowing, this is going to come at play and it's going to become quite a headwind for the Russian economy further down the line. Now, we had already seen that global growth prospects were starting to weaken after this major boost in economic growth post the pandemic. In other words, that post-pandemic growth spurt was beginning to fizzle out, even before Russia had invaded Ukraine. And once that invasion took place and commodity markets were in upheaval, we had an additional layer of complexity in markets, and we saw that international forecasters across the globe had started to pare back their growth assumptions on all economies around the world. In fact, if you have a look at this chart, the left bar shows us that the World Bank actually downgraded 70% of the economies that they cover in terms of growth prospects for this year. If you split this out a bit, on the right-hand side of this chart, you can see that the downgrades have been far more extensive for net commodity importing nations in the emerging market space. So that means that emerging markets that are reliant on importing things like food and fuel, which had experienced very high levels of inflation and were really at the coalface of some of these global supply chain issues, were experiencing even massive downgrades, more greater than what we've seen for advanced economies or emerging markets in general. Now, not only did we see global growth forecasts being lowered over time, but we've also seen that the range of economic forecasts out there has remained exceptionally wide. And I think this is one of the key things that has managed to underpin volatility in financial markets to date. While growth forecasts were being migrating lower, we've actually seen inflation forecasts migrating higher over this period. And the World Bank shows us that for the countries that have some sort of inflation target in place, the majority of these countries had experienced an inflation breach in the last couple of months. Now, just as we had seen on the growth front, where that range of economic forecasts remains so wide, we're seeing a very wide range of economic forecasts on the inflation front. That means that central banks are even more data dependent than they ever were before, and any element of forward guidance is now effectively being thrown out the window given this very wide range of forecasts that are out there. The monetary policy response to this high and rising inflation is, however, going to be different depending on the set of economic circumstances that each individual central bank faces. So, for example, if you are in the US or the UK, you would have experienced inflation outside of just food and fuel. We've seen inflationary pressures growing in other parts of the basket. As a result, central banks will probably hike by a bit more and a bit earlier to combat demand-led inflation. However, if you are an economy like the Eurozone, you've experienced relatively weaker growth since the pandemic, and inflationary pressures have mostly stayed within the food and fuel bracket. So we haven't seen inflationary pressures really broaden out to the same extent in the Eurozone, and this leads us to believe that the European Central Bank, or the ECB, is likely to maintain a shallower path of interest rate hikes from here. This shows us one of the main challenges that is faced by the Eurozone that's not a typical headwind for the US economy. In the US economy, the consumer bounced back very strongly, and we actually saw consumer spending exceeding pre-pandemic levels within a number of quarters. However, this did not happen in the Eurozone. As of the first quarter of this year, the consumer and business investment was still trending below pre-pandemic levels, showing a very soft economy. Add to this, we know that the Russian oil market and revenues from that oil market are doing reasonably well. So this suggests that the Russian government could actually just cut off total gas to the European market. This would be devastating for the European economy, given their reliance on Russian oil and gas markets. Now, even if they continue to diversify their imports or run nuclear or run the coal-powered stations a bit more, there's still a massive gap that needs to be filled. And this will probably force European markets like Germany or like France to actually impose demand caps on gas usage. And this is going to be very negative for the economy. So in a risk-case scenario, it's very likely that the Eurozone would fall into a deeper recession over this time frame, given the exceptional reliance on Russian oil and gas markets. An additional hindrance to the Eurozone economy is, of course, the weaker economies on the periphery. Now, during the pandemic, we had a situation where the ECB was keeping interest rates low, and they expanded the balance sheet. So they were trying to mop up the debt of these weaker peripheral Eurozone regions, where no one else wanted to buy debt from them because they were worried about the fiscal and debt situation. But now the world has changed, inflation is high, and there's a lot of pressure on the ECB to hike interest rates. There's also a lot of pressure on the ECB to rein in that balance sheet. That means that the ECB can no longer be the backstop that it was for economies like Italy, like Spain, like Greece, and like Portugal. Now, to resolve this problem, the ECB has come up with what they call an anti-fragmentation tool. And this tool is designed for the ECB to start mopping up that debt once again. In my mind, however, we are starting to move into a bit more dangerous territory. The ECB comfortably acted as an independent body for all this time. However, they now have to make a political call on a country like Italy, which is in political upheaval after the resignation of their prime minister. What they now have to do is to make a call on whether Italy is a viable country on an economic and political standpoint before backing that country by buying their debt. And this, for me, indicates that we are entering a bit of a dangerous zone, moving out of pure independence for the ECB. Now, as I said, there were very few countries that managed to escape this high and rising inflation. In fact, emerging markets really bore the brunt of this. Why? Because consumers in financial markets tend to have more of their wallet going towards food and fuel spend. On this chart towards the right-hand side, you can see a place like India, where half of the consumer wallet goes towards spending on food and fuel. So in an environment where there were very high price increases in food and fuel, consumers really came under significant amounts of pressure. Now, the Bank for International Settlements has shown us that there's a very good relationship between high food prices and high oil prices and an outbreak of civil unrest, social upheaval. And we've already seen this playing out in the last couple of months, with incidences taking place in Venezuela, Argentina, and of course the more well-known one being Sri Lanka. We also think that emerging markets are going to face an additional risk from the debt side as global financing conditions continue to tighten. So as interest rates go up in the rest of the globe, borrowing costs become more expensive for these indebted emerging market nations, specifically for the ones who have foreign denominated debt, so debt that's either in dollars or euros. And this becomes problematic at a time when they've already spent a lot on the fiscal side post the pandemic. They're already in quite a weak fiscal nick. This chart shows us that we have a record number of emerging markets that are either classified as being in debt distress or that have already defaulted. Now, we're not looking for some sort of Asian crisis to break out like we had seen at the back end of 1998. But we are saying that we could see some sort of domino effect rippling through the frontier markets, and this is a risk that we do want to flag within the emerging market composite. I said there were not many countries that escaped high and rising inflation, but there were a handful of countries that managed to do this. And most of them were in Asia. And I think one of the reasons this was the case was the response to the pandemic. In the US, we had governments literally writing out checks to consumers so they could spend money and buffer up economic activity. But this, of course, led to the rise in demand-led inflation. However, the response for many of the Asian economies was not to write stimulus checks to their citizens, and instead they would spend on things like infrastructure. So as a result, we haven't had that same element of inflation creeping in. Now, the two that we'll chat about within the Asian banner are China and Japan. Japan, despite having this massive amount of depreciation in the yen, are still sitting on the sidelines in terms of monetary policy. We haven't seen inflation really breaching out to other elements of the consumer basket outside of food and fuel. And the Japanese have said that their economy hasn't actually recovered that strongly since the pandemic. As a result, we're probably going to see ultra-accommodative monetary policy here for some time. The other one to notice is China. And in the recent week, we saw another cut in the lending rate, and that was really to boost consumer sentiment and to try and prop up the property market. Now, we know that China's had a torrid second quarter of the year. They imposed very strict lockdown restrictions. They've had the worst COVID outbreak in the second quarter of the year relative to the start of the COVID-19 pandemic. Based on their zero COVID strategy, they then clamped down on economic activity, and we saw activity grinding to a halt. Now, we are starting to see signs of lifting of restrictions in some regions, although they are still happening on a sporadic basis. We've seen cement sales picking up and demand for vehicles picking up. So we could see some sort of a recovery coming through for the Chinese economy for the remainder of the year. Yet consumer sentiment remains very repressed on the back of what's happening with these sporadic lockdown restrictions that's borne out quite negatively for tourism, but we're also seeing some negativity around the property sector. And as a result, we're not expecting to see much more than 3.5% in terms of growth for the Chinese economy this year before rebounding to around 5% for next year. So that brings about a second headwind in our minds for emerging markets, and that's essentially arising from the fact that we are now entering an environment of lower commodity prices, and the best is probably behind us. Fortunately, however, we do think that price pressures are showing tentative signs of topping out. The first of these signs is what's happening on wage inflation. Now, the chart on the left shows us a relationship between wage growth and job openings in the economy. And we know that in the US economy, there were many vacancies available. You'd walk past restaurants and bars, and there would be signs all over the place saying that they're looking for workers. As a result, we saw firms trying to pay up to try and actually fill those positions. But in April of this year, we saw that dynamic turning a bit, and you can see that the slope of the line became far shallower. That means that businesses were now so worried about demand in the economy because of rising interest rates that they then felt they may not need to fill all these vacant positions. And as a result, they became less willing to start paying up for these vacancies. So as a result, we are expecting to see a bit of a topping out in wage inflation, which is a good thing because it means that it's not going to spiral into the rest of the consumer basket in terms of raising inflationary pressures and that becoming more persistent. The second sign that we are also seeing that inflation is topping out is that supplier delivery times across the globe have now shortened quite significantly. And the third factor I'd throw in there is the fact that pandemic savings are now starting to whittle away. That means that we're probably going to get less of a push in terms of demand-led inflation coming through. Nevertheless, this still places central banks on a tightrope. It's a very difficult position to be in to try and combat inflation while protecting growth. If you raise interest rates by too soon and by too much, you could actually push the global economy into a recession. But if you take too long to raise interest rates and you don't do enough, you end up with inflation running rampant. Eventually, you do have to raise interest rates by even more. And as a result, the economy has an even harder landing that takes place post that point. Now, as we see things standing today, we know that there is a lot of concern about recession in the US playing out. Newspaper headlines threw up the headline that they had a technical recession. A technical recession is 2 consecutive quarters of negative growth. Now, there's a body in the US, the National Bureau of Economic Research, and they are the ones that actually decide whether an economy is in recession or not, and they do this in hindsight. Now, on that official basis, looking at the data that they look at, which looks reasonably robust for the US economy, they have determined that the US is not yet in a recession. We are of the opinion that we will see quite a significant slowdown in a number of economies, particularly the Eurozone and the UK, that are quite reliant on Russian oil and gas supply. But in the US economy, we have a set of fundamentals that are much firmer than what we saw playing out during periods like the global financial crisis. This time around, banks have much firmer balance sheets. Non-financial corporates are in a healthier scheme of things. And if we look at the household sector, we've seen that household net wealth conditions are the highest on record. As a result, we expect to see some sort of slowdown coming through from this interest rate tightening cycle, but we're not expecting a deep, prolonged recession to result. Now, bringing it all back home in the South African economy, we've also seen our Reserve Bank raising interest rates and taking quite an aggressive stance. Now, it's quite strange, you may think, because we haven't actually experienced the same rate of soaring inflation that other markets have, which is also quite odd for South Africa, that we actually bucked the international trend on this. It was only around May and June where we actually saw headline inflation starting to breach our own internal target. Nevertheless, we've seen the central bank coming out with a very aggressive stance. In July, we were, along with the market, quite surprised at the 75 basis point interest rate hike. We were looking for 50, as was the market. That followed a conversation between Bloomberg and Lesetja Kganyago, the head of the Reserve Bank, where he mentioned that, 50 is at the larger end of the interest rate increase. And this goes to the point of that economic range of forecasts out there being so wide and central banks being so data dependent. Between the timing of that interview and the time of the Monetary Policy Committee meeting, there was enough information for them to decide to actually raise interest rates by a larger increment of 75 basis points. The Reserve Bank are very worried about inflation expectations running out of control. Even though there are no signs of inflation broadening out just yet, they are worried that wage inflation is going to take hold in South Africa. As a result of that sentiment and their concerns about where inflation expectations are headed, we are now expecting a 75 basis point increment in interest rates at the September meeting, to be followed by a 50 basis point increment in November. Now, at that point, I think all central banks, not just the South African Central Bank, will now take stock of where inflation is. In the US economy, we've already seen one inflation print coming out a bit lower, but one swallow doesn't make a summer, so we'll need to see a couple more prints to see a consistent downward trend in inflation. If that does come through in the remaining months of this year, it's likely that the Fed will then take their foot off the gas pedal. Similarly, in the South African context, our Reserve Bank will also look to see whether we do in fact reach a peak in inflation around September, October, which is what the current market consensus is. If we do, and we start to see signs that inflation is coming down towards the target on a more consistent basis, we also believe that they will then take their foot off the gas pedal. If we are wrong about this and inflation continues to ratchet higher and shows no signs of coming back closer towards the target, I think this leaves the door open for more central bank increases. Now, we have a peak in the central bank rate of 6.75 because of the fact of inflation expectations on a longer dated basis starting to become unhinged. You can see what has happened in the recent quarter, where inflation expectations have ratcheted higher on the basis of food prices shooting up. As we mentioned earlier, as you're in your kitchen and you're now buying oil and it's now 50% higher than where it was a couple of months ago, your expectation of inflation then ratchets higher. As a result, the Reserve Bank wants to curb these inflation expectations. Remember that for the last couple of years, they worked very hard to get inflation expectations back down to the midpoint of the target band. That means that they're going to take an aggressive stance up front in order to get these inflation expectations back down again. But just like the rest of the globe, they do walk a very fine line. it's quite difficult for them to do much more than what we've suggested in our interest rate profile, given what the weak economic environment looks like. We are expecting economic growth to soften from the 4.9% growth rate that we saw last year, which was a post-pandemic bounce, to around 2% for this year. We're then expecting a softening in growth to 1.7% for next year. This will be primarily driven by a weaker consumer. We are seeing asset price inflation coming down. We are seeing higher inflation and higher interest rates, and this is likely to erode consumers' pockets going forward. If we look at this picture here, it shows us how the economy has performed since 2019. And you can see that on the left-hand side, 6 out of 10 economic sectors have not fully recovered. We haven't had a broad-based recovery, even though at a headline level, GDP is back to pre-pandemic levels. On the right-hand side, the picture is even more dire on the employment front. At the moment, we're probably getting the new statistics for labor, which are probably going to look quite dire. And what this picture shows us is that we haven't actually fully recovered our job losses since the pandemic in the bulk of economic sectors, excepting for the government and in the agricultural space. What about investment? Will investment save growth in South Africa? Well, we think there will be a little bit more investment coming through at the back end of 2023. And this is likely to take place on the back of the revised energy plan that was put out there by the president. However, in the near and intermediate term, we are quite concerned about policy uncertainty hampering investment decisions in South Africa. When manufacturers were asked, what are the top reasons for you not investing in our current South African climate, more than 80% of them said they don't feel comfortable enough to invest in South Africa because of policy uncertainty and a general political climate that is not favorable to investment. Now, that's not to say that all has been bad on the structural reform front. We've actually had a really good program designed by the presidency called Operation Vulindlela. It is a 5-year plan that's going to wind up at the end of 2024, and it was concentrated in 5 areas: water, electricity, transport, logistics, visas, which also includes a little element of tourism, and then the broadband spectrum. And we have seen some victories on that front, particularly in the water space, on the broadband spectrum, and in some cases, the transport and logistics. But I also just want to note that even in areas that seem to be the low-hanging fruit, like implementing emergency procurement of energy or trying to buffer up the energy availability factor, we haven't seen as much progress taking place because of government inefficiencies. Now, government inefficiencies essentially rolls over into longer-term fiscal concerns. And I put this slide together just before Enoch Godongwana's latest political development, where I said that, the longer-term fiscal concerns bugs us because we worried that the debt issue is going to start to pay for things where we have to crowd out economic development, social development, learning and culture, because we have to pay for these enormous debt costs coming through. But I'm now also beginning to get a bit worried about the short to medium fiscal consolidation trends. Our finance minister, Enoch Godongwana, was recently charged for sexual assault allegations. And if the NPA finds him to be guilty, he may have to step aside. Now, I think he's done 3 pivotal things that have been quite good for financial markets. The first is on the topic of social grants and the basic income support, where he has said he believes there should be a preference to rather support jobs growth and to support skills rather than to have an unconditional grant and a handout to citizens. This was taken quite favorably by markets. The second is he got quite involved on the wage negotiations to try and rein in the wage bill. And the third, markets really loved his tough love stance on state-owned enterprises. However, if the NPA does come out with a ruling that is negative, political analysts suggest that there could be 3 names that could crop up as a replacement. Barbara Creasy, who's in the Fishing and Forestry Department, potentially David Masondo, who is the Deputy Finance Minister, or Mameleko Kubai, who's been brought up in the echelons of the African National Congress. While she might be suitable to other roles, the political analysts suggest that she may not be as suitable for the finance position. And as a result, there is a cloud of uncertainty around fiscal consolidation in the medium term, resulting from these political developments that have taken place. I want to end off the presentation on a good and bad note. So the bad note is that we know that endemic corruption has crippled society, it has crippled service delivery, it has crippled our economy. The Fund for Peace calculates what they call a fragile states index. So on this index, you don't want to have a high number. The higher, the worse you are. And what this shows us is that because of poor security apparatus and failings in our economy, we are now registering as being weaker than a Russia, a Turkey, a China, or Brazil on this measure. The security apparatus issue was really one of the key reasons as to why the Financial Action Task Force team in October last year said that there are deficiencies in our economy. They gave us a 12-month deadline, which ends in October this year, to resolve those inefficiencies. They are a terrorist financing watchdog globally. And they've suggested that if we don't meet these requirements, they will place us on a grey list. Now, to be on the grey list is not a good thing. It means that it's more difficult for banks to interact with banks globally. It means that you have an additional layer of compliance, an additional layer of security checks, an additional layer of regulatory issues. It makes doing business much less easy. So this is not where we want to go. Now, National Treasury has put forward a set of rectifying measures, but there is an element of judgment that the FATF takes into account. So I think it really all will boil down to whether South African government has the political willingness to fulfill these reforms. Ticking the boxes on the technical factors is probably a lot easier, but whether we have the political willingness to do so remains a factor that keeps uncertainty around a potential grey listing in the air. The good note that I wanted to end on is that some commentators out there are suggesting that the grey listing will be the be-all and end-all for South Africa and worse than a sovereign rating downgrade. But remember that we are going to be grey listed, if we are, on factors that have been playing out for some time now. This means that financial markets have known about the weaknesses in the SA economy and may have already factored those into local asset prices. So things like the bond yield or the rand may have already incorporated some element of the bad news event. So while we could see some sell-off in the short term, if we do go on the path of the grey listing, the eventual outcome will be in February of next year. We don't think it's going to be a prolonged scenario. Remember that countries like Botswana and Mauritius were on the grey list, but managed to rectify the situation and get off that grey list within a reasonable amount of time. So I hope that was a good note to end with the presentation, and that you won't have to binge on the gin afterwards because of the sad economics presentation. Thank you so much for your time today.
Thank you. So I always learn something new every time I watch Sanisha present. In fact, this evening I'm going to go home and be very intelligent and act really clever and talk about our potential grey listing. I'm going to do that this evening at home because I learned that word today. Guys, can we give another round of applause to Sanisha, please? Next up is Ronnie Bornman. He's a portfolio manager for the Momentum Focus Fund of Funds. Ronnie's going to take us through the investment delivery of the past half year. He's going to provide an overview of the markets as well as the funds and their underlying mandates. Can we give Ronnie a round of applause?
All right, thank you very much, Andile, and welcome everybody. As everybody else has said, it's very nice to see you all face to face. So too for our online viewers today. Andile has stolen a little bit of my introduction. I'm one of the multi-asset portfolio managers, but today I want to talk to you specifically about the Momentum Focus Fund of Fund range, which some of your clients may be invested in. All right. Now, in contrast to Sanisha, and I hope you guys enjoyed her presentation as much as I did, it's always fascinating listening to our economists talk about their analytics and their outlook, especially for the macro environment and on a forward-looking basis. I have the slightly less enviable task today of talking to you about what happened in markets for the past 6 months and perhaps the last 7 months to July as well. Safe to say, we have been in very strict bear market territory for the first half of 2022. So as the slide sort of jokingly indicates. If we had to actually look at some hard data, however, you can see that equity markets essentially peaked on the 2nd of January 2022, and we've seen one of the worst 6-month starts to the year for equity markets in 50 years. Now, we're looking at the S&P 500 index here, but it may as well have been the MSCI World Index or even US Treasury bonds for that matter, and you would see a very similar trajectory for returns playing out. Now, how did we get to this point as at the end of June. I think Sanisha has already touched on a few of those issues. So in no chronological order, I mean, we've had a lot of high inflation expectations. We've seen some supply chain disruptions that was further exacerbated by China following a very strict zero COVID policy, in contrast to the rest of the world, who is in fact learning how to live with COVID just fine. On top of that, we can't forget about the Russian invasion of Ukraine. That has further exacerbated some of these supply chain constraints, some of the pressures on certain commodities, and in particular, obviously, oil and energy prices as it relates to the European Union countries and UK, and to some extent, the US as well. Now, following that, these inflationary pressures obviously rose even further. That caused central banks to hike rates even more aggressively, further fueling fears in the market. And obviously, equity markets don't like this very much. And that's essentially how we got to quite a dismal return as at the end of June 2022. Now, since then, inflation has, however, picked up, inflation numbers have printed a little bit softer in the US compared to expectations. And we saw markets rally by quite some margin in July. And August as well has not been a particularly bad month, but it has started rolling over in the last week or so, and we're now sort of back to neutral territory for August. Now, should we all just disinvest and go into cash? From our perspective, obviously, that is not a good strategy. If you are looking for perhaps a little bit less volatility, that is perhaps what cash will give you. But on a real return basis, even in South Africa, where we have some of the highest rates at the moment, we can see that inflation is outpacing cash rates by quite some margin, looking at it on a 12-month rolling basis. So if you were to move into cash right now, you would effectively be earning some serious negative real returns for clients. Okay, so just how did asset classes actually perform for the last year to date? Well, as we look at the far right-hand column over here, we can see, in summary, it's not been great. Local equity markets still very much in negative territory, so too for listed property. Fixed income assets have done slightly better, but relative to inflation, you can see not very good in real terms either. And then globally, whether you're looking at equities, bonds, or even listed property, that has also not done particularly well. Okay, quarter one, South African equities did do significantly better than some of their peers in the emerging market sectors. We, of course, had a lot of support with higher demand for certain commodities and some of our resource producers in that space. So that has helped buffer some of the sell-off we saw in other emerging markets. That was also very positive for the Rand, and we saw the Rand strengthening by 8.5% during that first quarter. So that has been very supportive overall for that market during quarter one. Fixed income assets, fairly neutral, and then in the global space, we saw markets selling off quite aggressively, and that was, of course, further impacted by the Rand's strength that we saw over the quarter, further sort of exacerbating those negative returns from those global asset classes. In quarter two, however, the picture reversed quite quickly. So the dollar effectively caught up with the Rand as well. We saw the Rand weakening by 12%. So the demand for some of these resource sectors that have been holding up the South African economy have weakened quite considerably during that second quarter as more and more fears around recession were growing in the economy. So that led ultimately to South African equities selling off quite significantly. Listed property followed suit. Even South African bonds were not spared. Despite fairly high yields on offer, bonds detracted by 3.7%. And in the global space, we saw significant negative returns. The S&P 500, I think, for the second quarter, roughly negatively 16%. I think the tech-dominated NASDAQ sold off in excess of 20%, but the Rand weakness has, of course, helped moderate some of those returns for a local currency investor. Okay, July, as I mentioned before, we've seen a bit of a rally in markets. South African equities came back, property came back quite strongly. So we did see some reversal of this negative trend in July, especially in the global asset classes as well. Now, what I want to talk to you about as well is a little bit more of the longer-term picture for asset classes. And I want to draw your attention a little bit to the 5 and 7 year returns, really. So if we look at something like South African equities, relative to inflation, you can see at 5.4 and 5%, relative to inflation hovering around about the 5% mark as well, that has not given us any real returns over the last 5 to 7 years. So it has been a very challenging growth environment. Local fixed income assets have done considerably better, and of course, global equities has been sort of the standout performer. Now, bear in mind, in a Reg 28 constrained portfolio, there would have been some constraints in terms of how much exposure you could have had to global equities during that period. We know that that has changed quite recently, but for most of those 5 or 7 years, you were quite constrained in your exposure to that strong asset class. Now, what does that mean for the average CISA multi-asset class fund in a Reg 28 environment? If we just look at the average of the 3 categories, so the high equity, medium equity, and low equity, we can see there that, first of all, the returns have really compressed. So you were not really compensated for the amount of risk that you took on in these medium and high equity multi-asset class funds. First of all, the returns have very much been similar to your low equity category. And second of all, I want to draw attention to the absolute level of the return. So this is relative to inflation. So as you can see there, on a 5-year rolling basis, where we are now as at end of July, the returns have just been marginally ahead of inflation. And as I've said, this has been the case for all 3 categories. Now, for July, 3 months to July, the picture has changed somewhat, but we're still suffering from that hangover in June. Local equities, despite being up in excess of 2% for July, for the 3 months to end of July, still very much in negative territory of 4.3%. Fixed income asset classes have recovered somewhat, and global asset classes, especially equities and risk assets such as listed property, have done significantly better. Now, what does it mean for the focus fund of funds? As you can see, we've had negative returns for the 3 months to July. A lot of that, as I've mentioned, has been from this hangover from June, and with local equity still down 4.5% on average, you can see that it has still been a challenging period for the portfolios that have a growth-oriented mandate. The green blocks there indicate the contribution to the negative return coming from your local equity component. So in the Focus 7 Fund of Fund, for example, nearly 2% of that negative 2.1 has come from local equities. The asset classes that were giving you some sort of positive returns have been cash as well as local bonds. Now, I want to just quickly rewind and take you guys back to the end of June, given that we have had such a peculiar sort of quarter. Now, I know a lot of your clients would have received their quarterly statements as at the end of June, and they may have asked some questions around the performance, why such a large negative drawdown on their funds. And I wanted to just put it into context. So if we look at the rolling quarterly returns of these funds for the past 10 years, let's call it 10 and a half years that they've been in existence, we can see that the distribution of returns generally sort of favor the positive side of the spectrum. You do have 1 or 2 instances there on the far left-hand side where we've seen strong negative returns. Now, on the far left there, 4 of the worst returns in the funds came during that COVID period. For rolling 3 months period, it has been the 3 months to end of March, and pretty much the same event has caused the negative return to 3 months end of April as well. So that accounted for some of the worst returns we've ever seen in the solutions in over 10 years. Second to that, we've had the resilient debacle. I don't know if you guys recall 2018, when listed properties sold off so aggressively in the South African market. That has caused some negative returns, the second worst that we've ever seen in the funds. And then just to put it into perspective, June, despite there not being any big single event, we've seen quite a strong drawdown, and that has been the third worst 3-month return that we've seen in the funds in 10 and a half years worth of existence. Now, should that be something that clients are concerned about? Well, in our mind, 3 months is a very short period. Literally, it is just market noise, effectively. When you look at it over a 12-month period, that tends to smooth out very quickly. So here we're looking at essentially the same graph, but I'm looking at a 12-month rolling return for the Focus 3 Fund of Funds. Now, first of all, what you will see is that the distribution is very much skewed to the positive side, as you would expect for this type of construct. It is also very sort of concentrated around a low growth outcome. And when we construct this fund, when we talk about a 95% VAR or a 95% capital at risk number, what we are trying to do is limit any drawdowns over a 12-month, rolling 12-month period to no more than 2.5%, with 95% statistical probability. Now, are you going to exceed that at points in time? Possibly, as we've seen with COVID, but that should certainly not be the norm. So in 95% of the time, we expect the return to be to the right-hand side of this chart. How far it goes depends on the risk profile. Now, in the case of the Focus 3 Fund of Fund, you can see we've had some phenomenal returns there at certain points in time, but it's very much sort of a low-growth solution. And happy to say that over the past 114 12-month rolling periods, the fund has actually achieved that metric 99.1% of the time. If we look at it, if we look at the Focus 5 Fund of Fund and we apply the same logic, first of all, you will see here that the distribution now becomes a little bit wider. You're taking on a little bit more risk, so you do expect a little bit more payoff on the right-hand side, but you do also stand the chance of possibly exceeding that 2.5% barrier on the low side. In fact, we construct this specific solution to have a 95% confidence of returns in excess of -5% over any rolling 12-month period. And as you can see, despite the COVID incidences, this fund has achieved that metric 96.5% of the time. And then lastly, if we look at the Focus 7 Fund of Fund, again, a very similar story here, but now you'll see that the distribution is much wider again. And this speaks to the risk profile being much more aggressive. You do get some outliers on the right-hand side, but you do also expect to occasionally have lower returns over the short term in the fund. And here we solve for a -10% drawdown with 95% probability. The fund has only exceeded that, again, as I've shown in those two cases during COVID. So we solve for -10%. 95% of the time, you're going to get a return commensurate with what markets is able to deliver, very importantly, on the right-hand side of this chart. Okay, and the fund has also achieved that 99.1% of all rolling 12-month periods since existence in 2012. Okay, fast forward 1 month again, back to July. If you look at the 3-month returns, as I've shown you, we still have some negative returns for that 3-month period. As I've mentioned, a bit of the impact of June still coming through there. The 1-year returns have moderated quite significantly since the COVID period when we were showing you strong double-digit returns. And bear in mind, these are snapshots. So as you move 1 month forward or back in time, this picture can change quite drastically. All right, but ultimately, I think over the long term, the funds remain credible, relatively ahead of their strategic benchmarks over most measurement periods, and also quite peer credible relative to their CISA peer groups. Again, bearing in mind, it is just a snapshot in time. Individual client experiences will obviously differ depending on when you enter that fund from point A to point B. Just a last note on the inflation-linked objectives. So the yellow numbers at the bottom there. We know that these funds, in addition to their strategic benchmarks, do have an inflation-linked target. Those were set during very accommodative sort of market environments 12 years ago. I mean, there was a point where we were getting CPI plus 20 in certain funds. So that has certainly not been the case for markets, as I've shown in the last 5 to 7 years. So those high inflation-linked objectives, currently not really achievable in the current environment, but obviously that is a metric that we sort of aim to when we construct the portfolios as well. So bear in mind when you have this conversation with the client to just moderate those expectations as well. Now, as Tanisha has shown, I mean, we don't know what the future necessarily holds in terms of the recession. How deep will it be? How long will it last? Should you capitulate? Should your clients de-risk potentially moving to cash? As I've shown, cash perhaps not the best solution, but the point is we don't know when markets are going to turn, and we saw this during COVID. So in COVID, we had significant drawdowns in the funds, but if you look at the recovery since COVID, a client who managed to stay invested would have earned, in a low-growth solution of Focus 3, up to 30% cumulative return in that period since then till July. Similarly, in the Focus 7 Fund of Funds, you could have earned up to 50% in returns. So that compares also very favorably with the CISA peer group averages. Then just quickly, I want to touch on the underlying components in the funds. And here we are looking at net returns after fees relative to gross benchmarks. So anything green there really is phenomenal. And happy to say that the largest part of these funds would obviously be in your local equity part of the solution. And that fund has given us significant alpha over virtually all measurement periods. Most of the local fixed income asset classes or fixed income components in the fund, such as our diversified income and enhanced yield, continue to do very well, outperforming their respective indices as well. Flexible fixed interest did suffer a little bit during the COVID period, a little bit of property exposure also in that fund at the time, but it has made a significant recovery since then and currently positioned more towards the long end of the curve, very much set to participate in any upside from this point forward. And we've already seen quite a nice recovery in that fund as well. On the global side, perhaps not that much green. Momentum Global Equity Fund, for example, and that fund we've introduced into the solution around about 3 years ago. It has been a very challenging time for global active equity managers. I think Natalie will speak to some global solutions later on as well, and I think you'll get the theme coming through as well. But equity managers, so we looked at our equity fund solution, and relative to other equity managers, it has actually done quite well. But relative to the index, we haven't seen great alpha from active equity managers. And this has largely been a factor of the index being so heavily dominated by the FANG stocks and tech, particularly during 2020 and 2021 when we saw that significant rally. So anybody who had any sort of underweight relative to those FANG stocks, which the index would have in it, if you had any sort of underweight to that, you would have lagged the index. And we see quite a bit of that coming through in many equity funds. Our emerging market equity fund, that's a new strategy, enhanced index strategy. It's doing exceptionally well for us at this point in time. Also a new addition to the solution. And there, I think the fund benefited from its Asia exposure as well as underweight exposures to Russia, for example, which was excluded from the index, as Tanisha has mentioned also during the first quarter of this year. Our fixed income solution, also a little bit of country and currency risk there that hasn't played out to our benefit. And then BlackRock Property is just an index tracker fund. So after fees, we do also have a bit of a lag there. So that sort of ebbs and flows, occasional outperformance, occasional underperformance, as you would expect. Now, I wanted to just talk you through our focus equity blend quickly. As you recall, for those of you who are familiar with the solution, we execute through 6 active managers, as well as a small cap sweeps passive component. And the aim of this blend is really to deliver cap sweeps plus 1 to 2% over any rolling 3-year period. We try and do that as robustly as possible, also limiting any downside to not more than 5% relative to the index over any 12-month period. And then the blend is designed in a way to give us our ideal exposures that we want to certain risk premia, those being momentum, quality, and value. Now, how has the blend performed? Well, in a nutshell, extremely good. So as I mentioned, we have a cap sweeps plus 1 to 2% expectation for the fund over 3 years, but the blend is actually delivering 4.2% outperformance relative to that index. So it has exceeded our expectations without taking on any additional risk either over the same period. Relative to the peer group average, also a very phenomenal outcome for this blend. Delving down a little bit deeper into the makeup of that blend and what has driven returns over time. Perhaps don't focus on the outright numbers here necessarily. We've color-coded them just for ease of reference. But what you will see there is that it's a very diversified exposure. Each manager in this blend is there for particular reasons in terms of what they contribute to the overall style of the blend, as well as our belief in their stock picking ability in that specific strategy where they were appointed. And as you can see, not all strategies are going to be in favor at all times. Quality and momentum has certainly been taking a beating of late. Value premia have been coming through quite strongly. But as you can see, the blend overall is working and it's very robust through time, as I've shown you in the top level performance of the blend relative to the index. The blend is also constructed in a way not to take significant risk in any particular sector of the equity market. Currently, if we just look at our current positioning, first of all, you'll once again see the diversification coming through there. The fund is currently skewed to resources, as you would expect in the current market. Fairly neutral on industrials and underweight in financials. Most of that stemming from underweight positions to property as well as certain insurance company stocks. If we just look at the top holdings of that equity blend, we can see quite a significant exposure, as you would expect, relative to the index in nice batch and process, some industrial stocks. We also have a lot of mining companies in there, some resource counters, as well as some rand hedges in the form of, for example, British American Tobacco. Right, so from a multi-asset class perspective, how are we currently positioned for this environment? As Sonisha has shown the road forward, there's still a lot of uncertainty. So we don't think this is necessarily the time to take very big idiosyncratic bets in the portfolios. We're not going to put all our eggs necessarily in one basket, hoping for one or two certain scenarios to play out. For that reason, we are a little bit closer to our strategic asset allocation at this point in time. So on the local side, equity, we still have quite a large chunk in our strategic asset allocation, so quite happy with a neutral equity position there. We think there are still some challenges in the local property sector, so for that reason, we are underweight. We do pick up some property as well through some of our equity managers, so we are quite comfortable with the amount overall. And then overall flexible bonds, we remain bullish on the sector. We think it's a good asset class at the moment, so our flexible bonds, meaning our nominal and inflation-linked bonds, currently at an overweight position, and we're funding that majority through an underweight position in cash. On the global side, fairly similar picture, neutral to underweight in equity at this point in time. Large cap underweight, just by virtue of the style and the strategy that we employ in that space, as well as a bit of a mid-cap quality value bias. Value has also been coming through quite strong on the global side of things, so we are quite happy with the current positioning there. Global bonds has remained underweight. We have added a little bit to that just as a hedge for future potential recession environment in the market. And then global property has remained at a marginal underweight position. What else are we thinking about in the funds at this point in time, just from a practical point of view? First of all, as you know, there's been some changes to the Reg 28 allowances, so allowing us effectively to take 45% exposure offshore. We thought long and hard about that. We modeled new solutions in terms of our strategic asset allocation. It did indicate that for our more aggressive solutions, we may want to take a bit more assets globally over the long term. So the strategic asset allocation of the funds will probably change over time to have more global exposure, but it hasn't been necessarily the right time to make those changes right now. At the end of the day, you have to sell something in order to go buy something, and right now we still favor local equities over global equities. We think there's a lot of value to be had on the local side from a valuation perspective, so not the right time. The currency has also been fluctuating quite significantly, so not necessarily the right time to make that change. Overall mandate changes, the funds have been pretty static. We haven't made any changes to the underlying manager lineup, but we are currently looking at potentially diversifying our global equity exposure by bringing in the Momentum Super Trends fund as soon as that fund is launched, just to diversify that equity exposure even further. Lastly, throughout July, we saw the currency actually weaken quite significantly, sort of to the low to mid 17 level. At the time, we thought it would be prudent, given our longer term expectation, let's say 12 to 15 months, for the currency to perhaps come back to the high 15s, low 16s. We thought it would be prudent to put on some currency hedges. So this is effectively protecting our global side of the portfolio to some extent from the rand strengthening from those levels. At the same time, should the rand weaken, we will also participate in any rand weakness up to roughly 20 rand 30. So quite a nice position there. The currency came back quite strongly to low 16s, but it has since blown out again back to the 17 mark. So should we experience further currency weakness, we may look at potentially adding to those currency positions just to take to sort of hedge our bets from that perspective, if our view on the currency hasn't changed, looking 12 to 15 months out. And then the last point I wanted to make is the alignment of the fund of funds and the model portfolios. So Dean is up next, talking to you about the model portfolios. We've been working behind the scenes to try and align the lineup of the managers within the focus fund of funds and the model portfolios. At the end of the day, when you sit in front of your clients, we want you to have a discussion about the solutions and not necessarily need to explain to clients why this solution has a different manager to this solution if it's trying to do the same thing. So we want that conversation more to be around the vehicle that you are using for that client investment. Okay, so that's my story. As always, we recommend to stay invested, but I think Aristotle said it better when he said patience is bitter, but its fruit is always sweet. So I'll leave you with that, and thank you very much.
Thanks, Annie. All right. Can we give another round of applause to Ronnie, please? How's the energy levels in the room? Are we okay? Can I ask you for one more session with Dean, and then we'll take a 10-minute body break. Is that okay? Is that comfortable with everyone? I can see some of your back teeth are starting to float. So we'll give Dean one session, so you've got his full attention and he's got yours, and then we'll take a little body break. Is that all right? Okay, so as I've said, up next, Dean de Souza. He's a Dean de Souza. Dean de Souza. Yes. He's a portfolio manager at Equilibrium, and he's going to chat to us today about the extent of the effect of investment markets and how this has played out in the MFP focus model portfolios. Let's give him a round of applause.
All right, thanks, Andile. I was hoping you wouldn't mention the breaks before my session. So I see the legs are going to be itching to get out, so I'll try to keep it relatively brief. Of course, Andile did mention the CPD and the free boost, so I know there may be some of you sticking around more for that than to listen to me, but I hope, as Donnie mentioned earlier, you get to take something from these, and we just hope to enlighten you on what's happening in the model portfolios. As always, for everyone watching at home, we hope you get to take something from this. So, I mean, without further ado, I think Ronnie has obviously painted a pretty bleak picture, so I'm not going to belabor the point on this slide, but I mean, I think it is quite telling that markets have been under severe pressure in the first half of the year, Q2 rather, being particularly bad. And maybe a tidbit of information that I picked up from one of the underlying fund commentaries is just the extent of the sell-off. You know, when the COVID sell-off happened, there was a lot that we could pinpoint to explain the sell-off. But this year to date has been a bit of a slower burn. And in fact, if you look at growth assets globally and you charted them on calendar quarters since the global financial crisis, so roughly from Q2 2007 all the way up to this latest quarter that we've had, you look at the S&P, the NASDAQ, the AllZ Top 40, credit indices globally, what you will find is that across all of those indices in their respective currencies, their performance for the last quarter was all within the 5 or 3 worst that we've seen since the global financial crisis, and that's 61 quarters. So it does put into context just the extent of the sell-off, and it explains a lot why we're seeing the portfolio performances that we are seeing. Maybe just to dive into the global asset classes in a bit more detail. Obviously, global equity was sharply negative, helped, of course, by a 12% weakening in the rand, but the extent of the dollar sell-off was such that you still experienced a negative return in global equities. Now, emerging markets did fare slightly better. Sanisha touched on and Ronnie touched on the sort of nonsensical zero-COVID policy that has been playing out in China. We did see a bit of opening up in the second quarter, and that helped emerging markets eke out slightly better returns than DMs. So EMs were still negative on the margin, whereas DMs were a lot more affected. In the property space, both local and global property, we saw almost indiscriminate selling. So markets have panicked around rate hikes. Sanisha touched on central banks hiking rates globally. And typically people fear rate hikes when it comes to local property, irrespective of the fundamentals. So, I mean, I think it would be fair to say that, you know, prior to these recent rate hikes, the fundamentals in property were little changed. And in fact, looking forward, we've probably seen perhaps the worst of local property fundamentals, yet in June we saw a particularly severe sell-off as markets panicked around the potential for rate hikes to hurt local property counters as well as global property counters. And in fact, if you look at local property counters, only 20% of their debt is actually subject to floating rate notes. Most of that is hedged out. And so it was perhaps very punitive on the local property sector, but nevertheless, it did explain some of the poor performance that we've seen. Global bonds in rand terms eked out marginally positive returns, of course helped very much by the weakening of the rand. Global bond yields continue to rise as inflation expectations continue to remain stubbornly high. Of course, we have seen bond yields reverse a bit in July, but they have started to creep back up to, you know, the post 3% marks because inflation still remains uncertain. Coming to the local side, SA equity delivered negative 10%, give or take, but we did see disparate returns from sectors. So starting with industrials, which was the strongest sector, that was very much helped by the performance of Naspers and Process. Obviously, Naspers and Process announced a share buyback, and the share prices rallied quite strongly. Of course, with other rand hedges, given the weakening of the rand, industrials held up quite nicely. Financials was the second worst sector. Banks in particular were hurt quite bad, which perhaps is quite surprising considering we are in a rate hiking environment. And I don't know about you guys, but the banks certainly aren't giving me any more money with the rate hikes going up, but I'm certainly paying them a lot more. And then finally on resources, the worst performing sector, as Tanisha mentioned, commodity prices have come off. And so with commodity prices coming off, resource companies in particular have been particularly hurt. SA bonds also had a bit of a tough time, down around 4%, obviously on a relative basis, better than what we're seeing from the growth asset classes. But you can certainly see that correlation between bonds and the rand. Obviously, the bonds selling off with global yields rising and some indiscriminate selling from foreigners. So I think our global foreigner holdings of our local bonds are some of the lowest levels that we've seen in recent times. And that is what we saw push bond yields up at the longer end of the curve and certainly hurt the bond market in general. As Ronnie painted, most of this has come back in July. Of course, should have been a bit smarter and pushed my numbers to July, but I think you'll get better news from Ronnie coming forward. And then lastly on SA cash, I mean, it does look better in the context of the other asset classes, but I think it's worth remembering that, you know, in real terms, cash is still sharply negative. And although we're seeing absolute numbers creeping up, the reward for sitting in cash in these environments is still not very much there. And that's certainly how we see it in the portfolios. So just jumping to how the portfolios have delivered since we launched them 15 months ago. So we have felt a bit of a tough time, obviously, over the last quarter and June in particular. And in this environment where we've seen inflation printing high, when you are targeting inflation and inflation is printing high, your benchmark is moving one way and asset classes are pulling the other way. So we've seen the gap between the portfolios and their benchmarks widen considerably. But I think what is important to see is that, you know, we aren't the only people subject to this. As you can see across all the peer groups, and as Ronnie had shown, everybody is subject to the returns that you can creep out from markets. And, you know, fortunately for us in these portfolios, since their launch 15 months ago, across the board, we are slightly ahead of peers on that basis. Of course, this is still a very short time horizon. There's a lot more to come. We still have roughly, you know, another 16 or 18 months in the Focus 3 portfolio, and then 2 to 4 years ahead before we get to the time horizons of these portfolios. So we do need to give them time to achieve their set benchmarks. Short-term time horizons are never a great time period to appraise these portfolios. Just breaking down the performance over the last year in particular. So what we do here is we look at the total return of the portfolios, which is in the far right column, and we try to break it down into what are the explanatory factors of the portfolio. Now, I think what is important is this is not a tool for us to say, you know, this is a manager we should fire today. This is a manager we should up. What this allows us to do is to just understand performance a lot better, make sure we agree with why the performance is delivering the way it is, and is to highlight any potential risks or unforeseen risks in the portfolio that may have crept in. So starting with the first column, which is our strategic asset allocation, of course, markets have been poor. So across the board, over the last 12 months, you've eked out 2.4 to 2.9% of returns. From a tactical perspective, so these are the overweights and underweights that we include in the portfolio, fairly negligible, positive on the Focus 3 and 7 portfolios, slightly negative on the Focus 5 and 7 unconstrained portfolios. From an investment manager selection perspective, in the more conservative portfolios, that being Focus 3 and 5, you can see slightly positive returns there, so our underlying managers generating some alpha, whereas in the more aggressive portfolios, which we'll come to a bit later, eking a bit of negative returns and negative alpha coming through there. And then finally, we obviously take account of fees and a trading effect, which is a sort of residual depending on, you know, when we trade in the portfolios versus how we calculate the returns. To dive deeper into that strategic asset allocation number, what you will see here, and as Ronnie showed, SA equities has been the big driver of returns in this environment, with a little bit of SA cash playing out. Rest of asset classes have been fairly negligible, although what I will point out is that it has definitely been a tougher time to be a global investor. You'll see all those bars at the bottom show you that being invested in global returns in this environment has not necessarily paid out. From a tactical perspective, we have been underweight cash. Now, given the poor returns we've seen in markets, cash being more defensive obviously would have helped us out there. Similarly, SA bonds, where we were largely overweight, they had a tough time, particularly in the second half of last year. Of course, we saw sort of August, September last year is where we had the first inflation fears, a very hawkish outlook from the Fed. and bond yields blew out last year, September. You might also recall we had the potential of a US technical default. So it was a bit of a tough time in September. Of course, in October, further inflation fears, bond yields continued to rise, but equity and property markets bucked the trend and actually rallied quite significantly. And so being overweight bonds in that environment did hurt the portfolio, and hence we're seeing the detraction from bonds. For the year to date, that has come back because bonds has been a bit more defensive. Where we have been a bit more fortunate is in being overweight SA equity. So this is pretty much a long-held view. Our bias towards local asset classes has certainly benefited the portfolios. And similarly within global bonds, where we've been largely underweight, given the fears of inflation and normalization in monetary policy, that underweight to global bonds has certainly helped us. Jumping to the investment managers. So I don't know how good your memories are, but you might recall that Visio in the Focus 3 at the last Outcome Matters session was laboring at the bottom. And this just goes to show how quickly fortunes can change and the importance of diversification in the portfolio. So we don't know which manager are going to perform at which time. We blend these managers together to ensure that through the cycle we get an optimal return profile. And what you'll see here is that Visio, owing to its more conservative nature, added value in the Focus 3 portfolio, given its significant component there. Similarly, Momentum Enhanced Yield gave us a nice stable return ahead of cash, which again contributed to performance in the Focus 3 and 5 portfolios. Coronation Global Strategic Income, a fund we've introduced as a proxy for global bonds. We did think to take on a bit more global bond exposure towards the end of last year, fearing the potential sell-off in global markets with the normalization in monetary policy. But we were hesitant to take on global bond-specific exposure purely because of that duration risk, with the probability of yields rising in the global space particularly high. So we took a bit more of a cash plus type mandate, and that has certainly paid off, so delivering quite decent value down the global bond side. And finally, ALIT equity, as Ronnie mentioned, the value risk premium have really played out in the South African space, and so that fund, being very much value biased, has added a lot of value. Now coming to the global side, Momentum International Equity Feeder Fund, which is now known as the Momentum Global Growth Feeder Fund, not fully invested in global equity, and as you will have seen to the end of the quarter, global property has underperformed global equities, and so this fund has taken a bit of pain for its more diversified exposure. That being said, we have seen the diversification benefits work for us in previous times, and so we still remain comfortable with that fund. Blue Alpha, as Ronnie has spoken to, quality has definitely not been rewarded in the South African space, and so given that he is very much a quality-focused manager, we do expect him to underperform in these cycles. And then finally, the one fund that we only use in the unconstrained portfolio, which has been the biggest detractor from performance, has been Coronation Global Emerging Markets. You may recall from our last presentation that this fund had quite a significantly large exposure to Russia as well as China. Of course, Russia shares have suspended trading, and so that's cost them roughly about 10% of performance. Similarly, they're overweight to China, given the zero COVID policy. Significant lockdowns has hurt their performance. That being said, we have seen this performance profile from Coronation in the past, and we do still rate them very highly as a manager. They're one of the best emerging market managers that we can find, across the globe. So not even looking, just in South African managers, but across the globe. And given the more aggressive nature of the strategy, we do need to give it time to play out. So just in terms of what we're thinking going forward and how we've positioned the portfolios, starting at the top with SA Cash, you'll see we remain underweight. As Tanisha mentioned, there is roughly 1 to 1.25% of rate hikes potentially still to come. We think once we get to that point, cash will be a much more attractive asset class to sit in, but at this point in time, we think essentially cash is trash. Inflation is still printing sharply ahead of cash, and therefore you don't want to get the negative returns from cash. In fact, like in the Focus Fund of Funds, we see a very strong overweight in SA bonds. Local bond yields are very attractive, for a potentially conservative asset class. You are getting almost CPI plus 4 to CPI plus 6 returns. And maybe for an illustrative example, if you take the SA 10-year bond, which is, as of this morning, trading at around 10.3%, and I think Ian is back after the break, so he can maybe confirm my math after that, but I think the duration on that bond is roughly around 7 years, and so if yields go nowhere, you will get your 10%, 10.3% return on a 10-year bond. if yields move up by 1% and you experience a capital loss, you get your 10.3% starting yield and you suffer roughly a 7% capital loss. So you're still making, call it 3% positive returns, which is slightly negative, but it's a still positive return profile. If, of course, the other side of it happens and bond yields normalize and come in by 1%, you then get that 7% capital appreciation kick. And we just think that that performance profile of a decent positive return skewed profile is something that we want to be in. And it's a much more favorable profile than perhaps something like SA property, which is offering you perhaps similar returns, but with a lot more risks at the tail ends. Perhaps somewhere where we differ is on that property. We are a bit more neutral. As I mentioned, we did say that we think the fundamentals of property are certainly, the worst of the fundamentals are behind us now. Property doesn't necessarily excite us, but we do think, given the sell-off that we've seen, in June, that current prices probably reflect all that bad news, and prospective returns from property at this point in time could be quite favorable, particularly over the medium to long term. And I think it is quite important to speak to our execution being a flexible property execution. So because we employ a flexible property mandate, we can employ this manager to move their property allocations a lot quicker. And what we've seen from Catalyst Flexible Property is that at this point in time, they actually are more favorable to global equity, or global property rather, and that has certainly paid off. But as the return prospects of those two asset classes change, they will tilt their portfolios, and we'll certainly see the benefit. SA equity is another place where we are fairly bullish there, so we are comfortably overweight across all of the portfolios. We do think SA equity, relative to history, as well as relative to global asset classes, are cheap, and fundamentals are somewhat improved. So another interesting stat from a fund manager was that profitability on average across SA companies are in their 99th percentile. So these companies are making a lot of money, and you're not paying very stretched valuations. And so we do think, certainly relative to global asset classes, SA equity is the space to be. And maybe circling back to my earlier point is that for a long time, it was not a good time to be a SA or local investor. We've moved into an environment now where you want to be a SA investor. And Natalie's coming up a little bit later, but she'll certainly paint a very bleak picture for global asset classes, as we've seen. So Natalie, as you will see there, global bonds, we remain underweight. We do think you're not getting decent value from global bonds at 3% on the US 10-year. We don't think that's sufficient compensation for where inflation is and the risks of yields going higher. On property, global property, fairly neutral there. Again, we use the flexible property mandate, and so that executes our tactical views on a bit of a faster and a better basis. And then finally, within global equity, we think overall you want to be neutral. You're certainly not sellers of global equity after, in dollar terms, they've fallen by 20%. But there's still a big question mark about what's going to happen to earnings. So Sunita touched on the recession risks in the global space. Fortunately, what we've seen is that most of the earning announcements to date have beaten analyst expectations. But given the future uncertainty, we'd rather take comfort in SA equity asset classes, which are priced a lot more attractively than sitting in DM equity. Similarly, with EM equity, we also think is a bit of a favorable position to be, given their more attractive valuations. Now, before I move on to the next section, which just speaks to a bit of timing in the markets and a bit of a behavioral finance aspect, I just want to touch on the strategic asset allocations as well. So, as Ronnie mentioned, we are looking to remodel the strategic allocations. Initial figures suggest that we will look to increase the offshore allocations by about sort of 5 to 8%, particularly in the higher factors. But it's going to take some time to get there. And certainly when I look at this picture and when we look at the environment for local asset classes, this is not the time to be expatriating money offshore. So as we see opportunities to take money offshore, we will use those opportunities to perhaps sell out of asset classes on the local side and allocate offshore. So just a quick exercise. Some of you might have seen this on the MFP Hub, one of the sort of reports that we put out. And this is just an exercise to show some of the risks of trying to time markets or trying to be perhaps too clever in these very volatile times. So what you're seeing on the chart here, I would have used the Focus 7 model portfolios, but we obviously only have 15 months of history, so I wanted to paint as true a picture as possible. And what you'll see here is essentially from the beginning of January 2020, so obviously pre-COVID, what your return experience would have been like had you stayed in momentum enhanced yield from that beginning up until the end of June. And similarly, had you been in the Momentum Focus 7 Funder Fund from the beginning of January to the end of June. Now, this is not to say that one portfolio is significantly better than the other. Obviously, the return profiles differ, but these portfolios are used in different contexts to solve for different investment outcomes. And very seldomly are clients' investment outcomes or investment goals dependent on what's happening in the markets. But let's say, for instance, that you were in the Focus 7 Fund of Fund at the beginning of January, and after the COVID crisis, you gave up and you said, you know what, I'm not going to be in markets. I can't stomach this volatility. And so you de-risked and you moved their entire portfolio to cash. Had you done that at that point in time, it would have been one of the worst mistakes you could have made. And as you can see here, assuming that you had R1 million invested at the beginning of the time, you would be out of pocket by roughly, 216,000 Rand, had you just de-risked to cash and stayed in up until the end of June. But the picture can get slightly worse. Let's say now that same investor decided at the end of 2021, after the spectacular returns that we saw from the bottom of COVID, he then decided to get back into markets. Where would his investment be sitting? And had you stayed invested throughout that time and just rode out the volatility in line with your investment goals, if you had R1 million, you would be sitting on, call it 1.1, almost 1.2 million. Had you then decided to get back into markets at the end of December 21 after de-risking, you would now be sitting at even worse position and would have lost a further, call it 80,000 Rand in capital. Now, again, this is not to say, that there's a good portfolio and a bad portfolio. This is just to show that try stick to your investment goals through time and just the difficulties that you can suffer if you try to time markets. And I mean, had I taken this on to the end of July, that could have been an even worse picture if somebody at the end of June, as I've seen a couple of our clients have done already, had decided to de-risk again and miss the recovery or miss the bounce that we've seen in July. So I suppose the takeaway here is stay invested, stick to the financial goals, give the portfolios time to deliver on their objectives. And, at the end of the day, the only way you can achieve your financial goals over time is to stay invested. By chopping and changing and moving around, the likelihood is that you're going to do more harm than good. Thank you for your time.
All right, I'm sure there's tons and tons of questions already forming in your minds, ladies and gentlemen. But I am going to ask, just maybe for one more round of applause for Dean. All right, as mentioned earlier, we're going to take a body break, 10 minutes. We will return to hear from Ian Scott. So I'll see you back in the room after 10 minutes. Thank you. All right, back in the room. Let's all grab our seats, ladies and gentlemen. Let's get started. All right, let's take our seats. I take it that break was very necessary. I see a lot of relieved faces in front of me. That was really necessary. All right, I'm glad to see that. Marinda really needed to go to the loo. I'm glad we could help, Marinda. I'm glad we could help. All right, guys, let's kick off the second half of the presentation. It is now my pleasure to introduce on stage Ian Scott. Now, Ian Scott is the head of Momentum Fixed Investment Income. He's going to look at the global short rate environment and then what the cash environment looks like in SA. Can we give this strapping young gentleman a really big round of applause?
Oh my word. Not so young anymore. Thanks, Andile. I just love being a... Hello, everybody. I just love being a contrarian. Dean just said cash is trash, and here am I saying cash, return of the king, right? And it is return of the king. We've not seen cash return in the last 3 years, and yet here it is, back. Okay. So 3 years ago, cash was trash, and Dean was correct. But the last 3 years have changed. Why? Because what you see on the screen, what are we seeing? The Fed, the ECB, the Bank of England, and Mr. Biden sitting on the right-hand side. The world has changed. So prior to 2021, or the middle of 2021, it was all about South Africa and what's happening to our inflation, what's happening to growth, and let's keep the politics aside. What has been the big change in 2021 up till 2022? The big central banks. Why? Because they sat on their hands, they wrote a check for 12 years to the market, and suddenly inflation jumped up and bit them where it hurts. And what happens? They sat on it, and they sat on it. They made a big policy error. They didn't hike rates. And what happened in 2022? Boys, inflation is the biggest problem in the world now. Now we've got to hike rates. Hold on to your bootlaces. And what are they doing? They're all hiking rates. And it's affecting us. So what? Kevin Lings always says, so what? So what? The Saab in the middle. It's suffering from a thing called FOMO, fear of missing out. So when these big central banks are going to hike rates, the Saab is going to follow. That's the so what we're going to follow. Right. Where are these guys going? Now think about it. You heard from Sanisha. Where's inflation in these countries? Well, US is 8.5%. Europe is 9%. The UK is at 10%. Wow. Yo. Where's their rates? 1, 2, 2.5. UK is 1.85. US 2.3. So all their cash rates are about 5 or 6% below inflation, right? Where are they going to? Well, maybe the Fed will go to about 3.25 by the end of 2022. You probably find that the UK will probably go to around 2%, maybe even closer to 2.5%. The ECB will probably go to 1%. It's got a big problem in Europe. Europe is a big problem. Why? Because you need a different interest rate in the northern part of Europe. So Germany, Austria needs a very different interest rate than what you need in Portugal and Spain. So the ECB is between a rock and a hard place. But what we're saying is interest rates are going up for at least the next 6 months. But this is the other problem, because it was all about inflation in the beginning of the year. And look, boys, we've got to do this. And hiking rates. What's the other problem now? Is when Dean talked around bonds, and I didn't want to talk about bonds too much today, is the inversion in the curve. Now, what do we mean inversion? Now, remember, when you think about an interest rate or a yield curve, longer bonds should be at a higher yield than shorter bonds, because there's a thing called term premium. You need to be rewarded for taking long risk. What's happened in the US? Other way around. 2-year rates are trading at about 3.30. 10-year rates are trading around 3%. At one stage, it was up at 0.5%. Means the market, the bond market, is very concerned around what could happen to US growth. What's the truth? Because everybody says, okay, now it's a recession. That's not the truth. Please don't go out and say, Ian Scott says there's a recession in the US. That's not what I'm saying. What is true is that in every time that you get an inversion in the US curve, there's a slowdown. But not every inversion leads to a recession. But there's a high risk of recession in the US. So now the debate is, how long can these central banks actually hike rates before they go, ooh, we've actually got to stop. And then we've got to cut rates. And that's why we think the window of opportunity is probably going to be 6 months. We think up till the end of the year, all these central banks, they're going to hike rates. Next year, they're going to cut rates. I know I sound like a madman when I say it. They're going to cut rates next year, because this is already telling us this is what's going to happen. Remember, this bond market prices about 1 year forward. Right. Why are we concerned around growth? Why are we seeing so much pressure on the rand? Why is the rand at 17? Why is the dollar strong? You know, why does it's corporate spreads? Now, this you would say, well, what does it really matter when Apple funds 5-year at LIBOR plus 50? What does it matter for South Africa? What's the so what? When spreads move up in the US, corporate spreads, when they have to pay more for credit, it's negative for emerging markets. So when this graph goes up on the right, the rand will feel pressure, bonds will come under pressure, emerging markets will come under pressure. So we actually need this graph to level out a little bit before we'll probably see a little bit of stability in the rand, stability in our bond market. That's the so what. Okay, so this is cash rate. So this is not the trash anymore, right? So what have we seen? The SARB have moved from COVID, the 475, up to 5.5 now. But the market, the blue line is saying, look, the cash rate is probably going to go 7.5 or more. So Nisha is saying to you, well, she thinks the SARB will probably stop around 6.75. That's fine. So we think, look, there's probably another 1.25% of rate hikes over the next 3 meetings. it could be 75s or 50s, but we get up to 6.5, 6.75 on the cash rate. But the market is pricing for 7.5. That's interesting. So that sits in the price. So we can today go and buy those rates in the market, and that's why we say cash is not trash anymore. Because think about where inflation is going to be. So this year, inflation is going to be 6.5 probably. But next year, because of base effects, you're probably going to have 5% inflation in South Africa. But the market is already pricing for 7.5. Now, Dean said to you, what's the biggest problem we have in the world with fixed income? Is the negative real rates. Interest rates are at 1 or 2% and inflation is sitting at 9. But that's not the truth in South Africa. In South Africa, what we're seeing in the bank funding curve now, this is where banks come to asset managers and borrow money. If we had to pull a straight line next year where inflation is at 5, you can see all these curves at the end are way above 5. There's real rates in South African cash. There's opportunity here, right? You're going to get above inflation increases in cash in South Africa. And I'll show it to you in a later graph as well. So cash is not trash anymore because the bank curves have repriced. So if you are worried that the world could go into a recession, well, South African cash is going to be one of those places where you can get real returns, but you don't take bond risk. Because remember, there's no duration risk in cash, right? Yes, we are positive about South African bonds, but that's probably a 3-year story. What we are saying is, if you are worried about the next year, because this recession will play out in the next year, South African cash is not going to be one of the worst places to park your clients' money and get a real return. Because this is exactly what we've seen. So remember when yields move up, the prices go down. And we always want to buy when prices are low. And that's what we're saying to you in this graph. You can see the yields go up, the prices have fallen, but the prices have fallen in the long end of the curve, let's say from 6 months all the way out to 5 years. You can clearly see from 1 year to 5 years, that's the most attractive part of that curve. So over the next year, if you can have a 7.5% yield on a 1 year, right? So 1 years are 7.5, 3 years are 8.5, and these long 5 years are 9.5. At one stage earlier in the year, we bought them at 10%. Now we're saying to you, if inflation, if the SARB sticks to its guns, inflation over the next 3 to 5 years could be 5%. And you're getting 9.5 or 10% out of a 5-year NCD, or what we call a zero. Guys, inflation plus 4.5. We're talking equity type territory at cash yields. So cash is not trash anymore. Even the government is saying it. So we're looking at the government T-bills, and they're just saying to you, look, 1 year is at, call it 7.5. Inflation 5 next year, you can buy government risk at inflation plus 2.5 without taking interest rate risk. We think there's good opportunities in the South African cash market. I think it's just not been focused on because we focus on long bonds. Yes, there's good returns coming from long bonds, but probably in a year's time or more. This is it. This is the graph, what I wanted to get to. The red line is where we're buying 5-year zeros. That straight line is where inflation is going to be. Look at that big difference. We're talking about 4%. CPI plus 4 from cash. That's attractive. From most asset classes, if you're worried that what's going to happen with that inversion, because I'm concerned as we stand here that, yes, I like the bond trade, I like the inflation bond trade. They're longer term trades, but the recession is going to hit. And what's going to happen in that period? Emerging markets will feel pain. So you will have drawdowns from risky asset classes, including bonds, including inflation bonds in South Africa, because it will be that risk-off environment where all emerging market assets sell off. This is going to be the one asset class that probably protects you from a lot of that sell-off into, let's call it the middle of 2023, because this will also go away, because as soon as the central banks start working out that growth has fallen, there's a recession there, or a slowdown, the SARB, the Fed is going to cut rates by the middle of next year. Then this will have disappeared. So what we're saying is the opportunity will probably sit there for the next year until the SARB cuts rates again, and then the bond trade will be on. So what is implied? What does the market still say about the SARB? Well, the markets, Tanisha said, 1.25% still up, but the market says, over the next year, look at the 9x12. We think the market prices that there'll be like 2.5% of rate hikes over the next year, more than 3% rate hikes over the next 2 years. Now, that's just silly, but it sits in the asset prices. Why is that important? Because the asset prices is what we can lock into the market. We know this is wrong, but this is also where the opportunity is. So what is the opportunity set for us value investors? When there's mispricing of quality or low-risk assets, we want to have them. We want to buy them in our portfolios. And that's exactly what we're saying about cash assets. That's why we're buying it into our income funds. We're buying it into our cash plus funds, into our enhanced yield funds, because there's this big mispricing of assets, of cash rates in South Africa. What else are we seeing mispricing? It's the credit market. Why do we think there's good opportunities in credit market? Well, it's basically a cash, well, it's a quasi-cash market because it's mainly the banks in South Africa and the corporates. But what we are finding at the moment is that less and less corporates are actually issuing cash into the market. They're creating a shortage there. Why? Because of dividend payout ratios. So if you look globally, most corporates in the world probably pay about 70-80% of their earnings out in dividends. What is typically the payout ratio in South Africa? It's about 40%. All these corporates and banks are sitting with a lot of cash on their balance sheets because they're not paying it out in dividends, so they're not issuing in the debt markets. They're creating a shortage, right? So, but we still think there's good opportunities in the credit market because think about it, for us as debt investors, we're not equity investors. We don't want them to run their earnings as hard as they can. If they keep cash on the balance sheet, it protects us, so it's more security. We like it. We like it when they keep cash on the balance sheet. Equity guys hate it because they're not getting it back in dividends in returns. So yeah, we think there's opportunity in the cash and cash plus space. So this was not a great market a year or two ago, but the corporates are much better. The balance sheets look a lot better. The property companies look a lot better. So there's good opportunities here. And then on the pricing side, we've seen the pricing change as well because when interest rates move up, right, spreads also move up. Spreads is the price that corporates pay over interbank rates, above bank rates, to us as asset managers to borrow money from us. And we've seen those spreads move up. I don't want to get technical on short, just know that the prices are falling in this market, right? So we're getting better opportunities here. Okay. So why is cash not trash? Why is it a better story in South Africa? Firstly, government finances. Government finances are actually not looking too bad, no matter what we read in the press. When the Minister of Finance is going to stand up in about 2 months in the medium-term budget, there's probably going to be about a 60 to 70 billion rand revenue overrun. That's not bad. If it was up to me, I'd give it all to Eskom, right? So that's not a bad story to have. So let's put a smile on our dial. Not everything is bad in South Africa, right? The monetary policy implementation framework. Oh, long word. Okay. Let's not get too technical. The SARB is busy engineering or re-engineering the surplus in what we call the interbank market, right? From a shortage to a surplus. Now you go, oh, so what? This is technical nonsense. It's not technical nonsense for those of us that's got debt out there. Once this is implemented, and there actually is an actual surplus in what we call the interbank market, it means the surplus cash that banks have, they can't just go and deposit with a central bank anymore because they're not going to earn an interest rate on it. And what do banks need to do? They need to make money work. And what will they do to make that money work? Well, they either can invest it, but they may or may not, there's risks with investing. So what the SARB is trying to manufacture here is, remember all of us, there's a prime rate and there's a JIBAR rate. Now, JIBAR is that interbank rate, but all of us, when we borrow a car, a home loan, an overdraft, what is it? It's, Mr. Scott, you're a great client, but prime plus 2, right? That's what happens to all of us. When that works, and I think what the SARB is trying to do, because we've been fighting for 25 years with the SARB about this, is trying to bring that prime plus 2 down. We want the banks to come out and say, look, we're sitting with so much cash. We actually have to lend money to the economy. And that's what the SARB wants to do. Mr. Scott, you're a great client. Because we've got so much surplus cash, it's not prime plus 2, it's prime plus 1.5. So watch this. This space is going to play out over the next year, that hopefully that prime plus will come down. I think there was an article this morning in MoneyWeb where SACOP, or the Business Council, actually said to the SARB, the cost of capital in South Africa is too high, the cost of cash, and they need to bring it down. So let's watch that space. Energy liberalization, we probably saw that, what was it, 2-3 weeks ago, the announcement by the president. That's a great thing. Right? That's a great thing. If we can try and sort out the nonsense of Eskom, we can all make power, we can privatize it. I think that's a very good thing. That will help That will help the economy, because that's what we need. We need the economy to have electricity. And then for debt investors, definitely, the restructuring of Eskom debt. Eskom debt is not sustainable. I said 15 years ago, take the Eskom debt onto the government balance sheet, and you'll save the spread. Because remember, Eskom trades at a premium to government because of the credit risk. I mean, government by default pays 1% more for Eskom debt than on its own debt. Why? Because it's government guaranteed. Take it on the government balance sheet. Saving 1% on 200 billion goes a long way. So there's good things out there. What worries us is these central banks that's making a policy error, because the risk in markets is always you double up on your error. So they didn't hike, the Fed didn't hike, and the ECB did not hike last year. What is the risk now? That they probably hike too far, or they're too hawkish for the most of 2022 and even into 2023, and then the economy is going into recession, and that's not going to be great for emerging markets. So yeah, global recession is not going to be great for us. I think Sanisha has already talked about the FATF grey listing. We just said, look, it's not a great thing for South Africa. We actually, as a financial industry, have to sort this out, because the so what is, the problem is, if we are grey listed, it equates to basically the same as a one-notch downgrade, sovereign ratings downgrade. So that's not great for any of us. And then load shedding. We've got to sort out load shedding. We can't keep going like that. So you can see it's not just a red story. There's a yellow story as well. And then, so what about returns now? So we say that, look, inflation, 5%, 6.5% this year, 5% next year, 4.5% in 2024. Well, we think, 7.5 type returns, even more from cash, that looks attractive on a risk-adjusted basis, and a very similar return from the enhanced or credit space. And then for those investors that we think that could stomach some of the volatility and take a 3-year view on South African fixed income, well, there's double-digit returns on the card. So, yes, inflation bonds, if you're worried about inflation, well, 9 to 10% returns, we think it's possible. How do we get there? Well, we say that typically if inflation is 5.5 or 6 plus a 4.5% real yield from South African ILBs, get you to that 9.5% type yield. And all bond index, look, we can actually get higher numbers here, but we're always conservative and say, look, we rather under-promise and over-deliver. But we think 11 to 12% return from South African fixed income is not unwarranted in terms of the yield. So we're not standing up here and saying, look, we're going to shoot the lights out with big returns. But think about it. If inflation is 5 or 6 over the next year or so, and you get inflation plus 5 or 6 from South African bonds, that's attractive from this asset class. It's liquid, it's government risk, and we said your government finance is actually not looking too bad at the moment. So yeah, we're still positive. But what I wanted to talk today was around cash is not trash, and you can clearly see that there's real returns in South African cash. So we think the opportunity set is really attractive. It's been an underloved asset class for the last 3 years. But we really say, well, look, don't go and sit in bank call accounts at 5 or 5.5 when you can get these 7, 8% returns from the South African cash market. Cool. That's it. Thank you.
Thank you very much, Ian. So when I do stumble onto that pile of cash, there's oodles and oodles of cash that I'm hoping is coming my way soon. It is going to come directly to your business. You have my absolute word on that. Can we give Ian another round of applause, please? Cash is not trash. Some food for thought. I don't know if you picked it up, but that was a little bit of a celebrity death match in front of us in the investment world. Little bit of a him versus him. That's how it looks in the investment world, ladies and gents. We'll have gloves next time. All right, so it's now time to welcome Natalie Harrison on stage. Natalie is the Global Fund Specialist at Momentum Investment, and she's going to provide us with a brief update on the global landscape, giving insights into the drivers behind market returns and the consequent effect on the Momentum Offshore Fund's returns. Can we give her a big round of applause?
Afternoon, everyone. Great to see you guys face to face, and for those joining us virtually today. I've clearly got the enviable role of talking offshore because everyone's painted such a brilliant picture of the landscape there. So I can't wait to tell you more about what's been going on there. But as Andile said, I'm the Global Fund Specialist, and I look after Momentum Global Investment Management. It's our offshore-based investment team based out of the UK. And they manage the MFP Global Houseview, namely the Momentum Global Cautious, Momentum Global Managed, and the Momentum Global Growth Fund. So what I'm going to be touching base on today is a bit of an overview on the markets and how that has impacted returns, and importantly, our outlook going forward, because clearly it's been a bit of a bloodbath. It's difficult. I'm sure conversations with your clients are difficult. So I want to give you a bit of some insights into what you could potentially take out your clients that are a bit more positive, because I think there's always, when there's doom and gloom, there's always opportunities on the horizon, and I think that's something that I want you to take out to your clients. But firstly, I want you to think back to last year. I've recently had a kid, so I've got baby brains. So I can barely think about what I did yesterday. But if you had to look back 1 year to the end of June 2021, these are your returns. These are the returns that your clients would have been seeing on their statements. These are returns in dollars. If you look at the US equities over a 1 year period was up 40% as at the end of June 2021. Your global developed market equities up 39%. Global property securities were up 31%. It's generally a positive circumstance all around. Now, take it 1 year forward. And this is the situation that we're finding ourselves in now, which is significantly different, and which is, I'm sure, a big reason why for you're having very difficult conversations with your clients. And we, as fund managers, definitely empathize with you regarding that point. But what I wanted to highlight is you can just see how stark those return profile has been, and you can see how market circumstances can change so swiftly, and why obviously staying invested is so important when trying to achieve your long-term investment goals. But just to talk to that offshore investment portfolio, offshore returns, as I said, these are in US dollar terms. US equities on a 1 year basis down 11%. Year to date down 20%. That's a bearish market. That's a bear territory, which is very negative. China equities down 31% over a 1 year period. Emerging markets, global properties, it's been bloodshed everywhere. The only positive light has been UK equities, which has been seen more of a value area, and they've also benefited from the energy resurgence, which we've seen. I wanted to highlight that US Treasuries line, because US Treasuries are more often used as a safe haven asset class within an investment portfolio. They generally provide protection when markets are in downside, and that's why you generally have a mixture of risk assets with more conservative assets to provide protection when necessary. What we found this year, so this almost links to what you saw earlier with Ronnie's picture on the S&P 500, but this slide here highlights the performance of US Treasuries over the last 45 years. So this is the annual return path over 45 years. It's quite faint on this graph, but if you look at those gray lines, those represent every single annual return over the 45 years, with the average return from US Treasuries being around 6.95% in dollar terms, which is a pretty attractive return profile. Now, if you look at that red line, that's exactly the circumstance we're finding ourselves this year. It's been the worst performance we've seen in the last 45 years for global bonds. And so for a seemingly well-diversified investment portfolio that combines risk assets as well as defensive assets, it's been a very difficult time for fund managers like ourselves to navigate market circumstances like we find ourselves in now. Hence why the team's saying it's tough to talk to global markets, because it really has been a tough market circumstance. So what has been going on? I mean, Sunisha gave such a brilliant overview as always, and so is the rest of the team. But I think these are some of the newsprints that your clients likely see in the market these days. There's been so many moving parts. Unprecedented was a term that was thrown out so many times during the COVID pandemic. But I think we really are facing unprecedented times now, just because how many moving parts there are taking place. And Sunisha also mentioned that earlier. We've had a war. We've had inflation prints that have been sky high, decade high. We just saw the UK print come out at 10.1%. As a result of these soaring inflation prints, we've had Feds and various central banks across the world aggressively raise their interest rates, as we've heard many times already. And then Ian just made reference to the fact that there's now recessionary concerns, and there's concerns that the Fed is going to be, and central banks are going to be too hawkish, and it's going to put dampeners on growth going forward. Not only that, you've had strict COVID lockdowns, which has just worsened the situation taking place in China, especially given all the supply constraints that happen as a result of COVID. And then there's additional political circumstances that have been taking place. We had an assassination of the ex-prime minister in Japan. We had the president of Sri Lanka flee the country. We also had the resignation of the Italian prime minister. So there's been all those moving parts, which has been obviously creating a hell of a lot of uncertainty. But clearly, the main drivers of the uncertainty and the negative returns that we've seen in the market has really been interest rates or inflation, or soaring inflation, and the aggressive interest rate hikes that have been taking place across the board, which the teams obviously already said. So I'm not going to harp on this because this has really been talked to quite a lot, but this is the inflation. You can just see how inflation in the US has skyrocketed. This is as at the end of June. It's recently come down to 8.5%, but clearly it's at decade high levels. And this is why the reality is inflation is not a joke. And the big reason why central banks have had to aggressively raise interest rates is because if inflation runs away with itself, it's harder and harder to bring back down. And I think this is just an interesting slide to highlight this point. I'm not really making any parallels between the US economy and Turkey and Sri Lanka, because clearly they are very different in their structure, US being the biggest country in the world and obviously much a bigger, more successful economy. But what's clear on the slide is that if you don't curtail inflation, it can run away of itself very, very quickly. The Sri Lanka CPI is in excess of 54%. Turkey is in excess of 78%. And that's why, because of this concern of runaway inflation, we've had central banks across the world aggressively increase their interest rates. And we've heard about this many times. But you can see this is the number of interest rate increases by 55 central banks that the Financial Times tracks. And if you go back to 2003, this represents the number of interest rate hikes. You can see towards the right how many interest rate hikes have been taking place this year. Quite significant. We are really entering a very different environment, largely as a result of these high inflation prints. Because of these, market conditions have been exceptionally poor. Market returns have been coming under pressure, as you highlighted before. And how this relates to the Momentum Global Managed Solutions is, of course, the performances of our offshore-based portfolios have also come under pressure. We have not been immune because, as you would have seen earlier, diversification has not really come to the fore, has not helped us in managing these portfolios effectively to achieve the return targets we've set out to achieve for our clients. As a reminder of what the Global Houseview comprises of, there's 3 portfolios. It's the Momentum Global Cautious Fund, the Momentum Global Managed Fund, and the Momentum Global Growth Fund. These funds all target a global cash plus return target over a designated time horizon, being 3, 5, and 7-year period. We have these portfolios in both dollar terms as well as in rand-denominated feeder funds. And as a result of the broad-based sell-off, the performances of these portfolios have been negatively impacted. So this is not something that I can hide from. If you look at for over a 3-month period and the 1-year period as at the end of June, you can see the returns of the portfolios have been under significant pressure. Global Cautious Fund is down 16%, Global Managed down 16% similarly, and Global Growth Fund down 16%. So you can just see how diversification, a more conservative portfolio, has performed nearly very similarly to a much more aggressive portfolio. So diversification that would normally provide protection in a market sell-off has not come to the fore just because, as I showed you earlier, global bonds and various other asset classes in the fixed income space has been decimated, pretty much broad-based. Now, if you relate that into the rand terms, we already heard earlier that the rand has depreciated over this period, and that is why, if you look at the bottom, those highlight the rand-denominated returns of the feeder funds, whose returns over a 1-year period, a 3-year period, 5-year period, and since inception is obviously superior just because it takes into account the positive rand or the negative rand appreciation over that period. Now, what has helped So obviously, because at the end of the day, everything's been pretty much negative, and that's not something that we can hide from. But what has helped is that we bought into specific type of asset classes last year that were attractively priced. Areas, as an example, that we really like and still currently have a significant overweight to is Japanese equity. We've bought into a business called Morant Wright Fuji High Yield Fund. They're a Japanese-focused equity manager. On a return perspective, year to date, they have returned negative 5.8%, but that is significantly better than what we've seen in global developed markets, as well as the S&P 500. So it's been a relative outperform in that space. And a big reason why it's outperformed is because, number one, we bought into it at an attractive price. Valuation is always an important consideration when asset allocating to asset classes. And then also this particular portfolio has a quality value type of style. And if you've read any of the commentary, an investment style that has done particularly well this year has been value, whereas growth type of styles have come under pressure more recently. We've also diversified our risk asset exposure. So we've been underweight equity relative to our strategic asset allocation in favor of more diversified risk asset exposures in the form of real assets and infrastructure. And a big reason why we decided to overweight to those particular areas is because we were concerned about the inflation outlook, which obviously has materialized. These two portfolios have benefited from the fact that a lot of their earnings are linked to inflation, and they've been important diversifiers within our investment portfolios. Now, what has hurt? Some of the areas that have hurt our portfolios more particularly is, number one of our allocations to private equity. I'm going to touch base on it just now because we really like private equity as an asset class. But we bought into the particular security, this particular security, too early on. It was already at a discount to NAV, so trading at a 40% discount to NAV, which is a crazy entry point, a very attractive entry point into a very attractive asset class. But unfortunately, the return profile has since come down further, but we are very positive in terms of the outlook going forward for this particular asset class, and I'll touch base on why we like private equity just now. Commodities, gold producers have also come under pressure, and then emerging markets. Dean made mention of the Coronation Global Emerging Market Fund and what has impacted that particular portfolio, being China exposure and Russia. This is exactly the same impact that has happened, same areas that have negatively impacted the Fidelity Emerging Market Fund, being its exposure to Russia, which was reduced to zero, and then its Chinese exposure, which has obviously come under significant pressure. We think that emerging markets as an area, just like Dean mentioned earlier, is very attractive longer term. We like emerging markets. We've actually recently increased our exposure to Chinese equities in particular because we think that the outlook for returns from that area is attractive longer term. But this is in the short term, and you saw in my first opening slide that things can change quite quickly. And that's why I think it's always important to not only focus on short-term returns, but look back in terms of how we have delivered on the longer-term investment profile of these particular portfolios. As outcome-based investors, we're trying to achieve our specific return targets over designated time horizons. This slide here highlights the global cautious, global managed, and global growth funds return profile, cumulative return profile against their benchmarks going back since March 2008 when these particular portfolios were launched. And it has clearly outperformed those reference rates over that period, which is a really great outcome. But to be more specific in terms of the funds, if you look at the Momentum Global Cautious Fund, this particular portfolio is more of a low equity solution. Over a rolling 3-year period, it has managed to achieve that global cash plus 2.5% return target 70% of the time. In terms of the Global Managed Fund, it has managed to achieve its global cash plus 4% return target over a rolling 5-year period 87% of the time. Then if you take it to the Global Growth Fund, the Global Growth Fund has managed to achieve its cash plus 5.5% return on a 7-year rolling period 91% of the time. So no matter really when you enter into these portfolios, clients would have actually more often than not achieve their return target that they set out to achieve, which just highlights the importance of staying on the course of the particular strategy that you've chosen, because the portfolios, through their broad-based diversification, has been positioned to deliver on those outcomes longer term. Just in terms of our outlook going forward, this is quite a busy slide, but it just highlights our views in terms of equities, fixed income, and alternative asset classes. Big picture, we favor equities over fixed income, and we also particularly like alternative type of asset classes, including infrastructure. Private equity is an area, certain private equity securities is an area that we like, and then liquid alternatives. A reason why we prefer equities over fixed income is just because what everyone has said, fixed income globally is offering negative real yields, but there are opportunities in other fixed income asset classes, which is an important area that we have started to take advantage of, such as Chinese sovereign debt, which is actually providing a positive real yield. In terms of another area is Asian high yield credit. There's been a lot of negativity priced into that market given the significant decline in property markets in China in particular. So it's an area that we've recently taken a position in, and it's actually benefited more recently because China's cut their interest rates. But big picture, we like equities longer term. We have not got an overweight allocation just because there's a hell of a lot of uncertainty still to unfold. We'd rather err on the side of caution and look for and try find opportunities in other areas that we think are screaming great amounts of value, and there are positive areas that I'll highlight now. Some of those areas that we have taken advantage of, as an example, is private equity. Schroders UK Public-Private Trust is a private equity firm that we really like. Another one of those securities that we bought in at attractive valuations. Chinese government bonds is a great diversifier in a global fixed income mandate. And a big reason is because it's actually providing an attractive yield. Inflation in China is much lower than what we're seeing in global developed markets. We've got Asia high yield credit. I mentioned earlier, it's an area that we really like to diversify our fixed income exposure because we are so negative on sovereign debt in developed markets. And Chinese equities is a particular area that we like and recently significantly increased our allocation to that particular area. And these are just areas where we've made subtle changes in terms of our allocations. Just in terms of opportunities, I think this is an important thing to highlight because there's been a hell of a lot of negativity in the market. And it's always important to realize that when there's market turmoil, opportunities always arise. And that's when an investment team like ourselves and my local team members as well, we're continually looking for opportunities to not only improve the alpha generation that we can achieve for our clients, but more importantly, improve the outcomes that we're trying to deliver for our clients longer term. One of the areas is value. So we've seen this year that value has outperformed growth securities. There's been a relative outperformance of value style relative to growth. I think what's very important to understand that despite there's been that outperformance year to date, over time, there's still growth stocks are still trading at a significant premium over value stocks. So we do think that the opportunity for value to outperform is still there. This slide here as an example just highlights the relative valuation premium of growth over the MSCI World Growth Index over the MSCI World Value Index. And you can just see how the premium of growth stocks over value stocks, where they're trading. So this is on a price to earnings ratio basis, price to sales, price to book. So clearly, value still is an attractive opportunity and a big reason why we still hold a balanced investment style allocation within our equity mandates within our portfolios. Other area is private equity. I've already mentioned earlier, but we've bought into a lot of these securities at a really significant discount. We bought into the Schroders UK Public-Private Trust at around a 30% discount to net asset value. Same as that Chrysalis portfolio that I highlighted earlier. We're a little bit too early in that, but we think the opportunity for upside is big for a longer term investor, just because they're providing you access with really attractive securities that are not yet listed. There's a trend globally for companies to stay private for longer, and/or there's a trend globally for companies to delist, We've seen this in South Africa, we've seen that globally, and that's why private equity is a really attractive asset class to take advantage of different type of companies that you otherwise would not have access to, and it's an area that we're taking advantage of. Chinese equities are also, as I mentioned earlier, they're looking really cheap, and we've recently taken an overweight position there. And opportunities in Asia high yield credit. I'm not going to delve into this too deeply, but you can see here, this is the performance of the China Real Estate Index. And when there's been significant declines in the Chinese property market, it's often been a great opportunity to take advantage of buying the debt in that area. And that's an area that we have recently bought into. I've got a few seconds left to cover, but I wanted to highlight just the importance again of staying invested. Things can change so quickly. That was my first slide, how different those annual return figures were. We've seen this month, in addition, July was a really positive month for global markets. Year to date, pretty negative, but last month was really positive. So trying to time the market and trying to exit and enter is really difficult, and that's why staying invested is always so important. And even more so, I think this slide is quite interesting because it highlights the importance of staying invested. What this slide here highlights is that if you had invested $100,000 into the S&P 500 back in 1999, and you remained fully invested up into June 2022, that $100,000 would have grown to $432,000. But if you decided to time the market because you were concerned at what was going on, and you missed the 5 best days, that $430,000 would actually be $273,000, just because you missed the 5 best days. If you missed the 20 best days, you wouldn't have had $400,000, you would have actually had $117,000. So trying to time the market is really difficult, and rather staying invested is very important to ensure that you achieve your international investment goals, and that's something I want you hopefully to remind your clients. And then my last point, you've probably seen this many times, and I thank Renee for, doing the animations for this particular block. That would have killed me, I think. But what this highlights, I think, is just the variation in returns of asset classes, both locally and globally. What I really want to highlight in this is 2 things. Number 1, timing the market is futile. It's really difficult to get right. If you look at commodities as an example, in 2020, commodity prices were negative 7.69% in dollar terms. Last year, it was the best performing asset class, up 41%. So try to time that entry and exit, it's really difficult. Number 2, overall, it's so important to have a diversified portfolio of asset classes, both locally and offshore. And that's obviously where you can lean on our local investment team to help with their portfolio construction of their local solutions. And from our perspective, our offshore funds will definitely have a valuable play if your clients are looking to externalize their assets offshore. I know it's really tough. That bloodshed on statements is really difficult to, I'm sure, navigate for your clients. But in times of turmoil, as I said, opportunities arise, and without a doubt, our team in the UK is definitely positioning the portfolios to achieve those return targets we've promised your clients over time. So I'm going to hand over to Andile. Thank you for your time.
All right. Thank you very much, Natalie. I couldn't help but notice, I think it's the marketer in me, I couldn't help but notice, there's a lovely slide you've got with headlines where the Sri Lankan Prime Minister, I think they fled. Is it fled? They fled or fled. It also says they fled to the Maldives. I think as far as I'm not one to criticize the places to flee, but I think if you're going to flee, the Maldives might be one of the better options of where to go. I think that's probably a good place to flee. So if anyone's thinking of fleeing, that's probably a good place. Can we give Natalie another round of applause, though? Okay, let's move on with our program. Next is somebody who none of you are a stranger to. Paul Nixon is going to talk about, he's the head of behavioral finance, investments head of behavioral finance. He's going to talk to us about something that I thought was very interesting, the disposition effect. Now, the disposition effect is not that movement that you make when you really need the loo in the car and you're chasing the next. This is a different disposition effect that is running rampant among our investors, and he's going to explore strategies that work to minimize this effect or the effects of this bias. Can we give Paul a big round of applause, please?
All right, good afternoon, everyone. I've realized two things as I was kind of jumping up onto the stage. Number one is I think I'm the relief act. Okay? So I'm not going to be showing you kind of bloodshed and horrible red stuff, and I'm going to be talking about how people react to that horrible stuff, right? And then the second thing is, given that there's a gin tasting afterwards, isn't it kind of a nice place to be where the world is now? We're putting the alcohol in the right place, right? We're putting it in our mouths these days as opposed to kind of on our hands, right? So that's kind of something to celebrate, which is a positive spin on what we've talked about today. But I think as we start unpacking, there's a lot of research that's coming out and being published on the psychological effects of COVID. And I think, many of us in the room, right? So, hands up in the audience, who's experienced conflict amongst family and friends because of opinions about vaccines, right? So me, right? So we definitely, we've had a relationship in the family which is 25 years where people aren't speaking to each other anymore, right? Because of opinions about vaccines. So this highlights the importance and how people, what's interesting to a behavioral scientist is how people formulate their belief systems, right? And how strong we get. And when someone challenges our belief system, generally what do? We double down, right? So we get very, very, very entrenched in those belief systems. But that's not what we had to talk about today, or kind of is what we had to talk about today. So we're going to talk about the effects, or the psychological effects in terms of the disposition effect on South African investors. And I think COVID, what it's done is it's kind of just turned up the dial and amplified our cognitive and emotional biases, which is something I'm going to talk about today, which is some interesting research that we've done on the Momentum Securities platform. All right. So before we, by the way, if you don't get this stuff until you work at a bank. So if you've worked at a bank for, you find this stuff hilarious. If you haven't, big insurance company, I think will kind of get you there, but you have to kind of work at a bank, I think, to understand Dilbert and Dogbert. But really if we're going to understand the disposition effect, we need to understand something about the frame, right? So that's the frame, or the frame through which we look at decisions. Now, the frame determines our perception, and of course, the perception determines the way we feel, and the way we feel determines how we act. Right now Dogbert, as usual, have a very, very cynical and wonderful way of looking at this stuff. And what Dogbert Consultants is doing here in the first frame with a manager, you will see that he's saying your fake 50% sales price makes dumb customers feel like smart shoppers, right? Now, that is absolutely true, right? And marketers and retailers have known for many, many years that they need to get us from the spend frame, again, frame, right, to the save frame. Because people are naturally loss averse. We don't like parting with our money, right? But if it's 50% off, you're actually saving 100%, right? If you buy stuff, right? And that frame change determines how we feel, our perception, and our perception, again, determines our behavior. And then if you go into the second frame here, of course, what the manager's now saying, well, why am I paying you $400 an hour to tell me kind of what I already know, right? And Dogbert's response is, well, I usually charge $800 per hour. Okay, and this, of course, leaves the manager, yes, I'm a genius, of course, falling prey to exactly the same tactics that he probably uses in his stores. Now, you might see this as a little bit kind of, you might downplay this a bit, but let me give you a practical example to show you how powerful this effect is. So I'm going to take you back to 2011. Ron Johnson was headhunted by JCPenney. Okay, so America's largest discount retailer. And Ron Johnson's claim to fame was Apple, right? So he was headhunted from Apple, and he designed their store experience, right? So by the way, if any of you have ever had the opportunity of visiting a proper Apple store, please do so. It's not the rubbish that you get at iStore here, right, which is a bit of a disaster. If you go into a proper Apple store, it is wonderful. It's a really, really great experience. And Ron Johnson was instrumental in designing that store experience. So they got him to come, and I guess he brought that kind of legacy with him. And the first key decision he made in JCPenney, one of the largest US discount retailers, is to change the pricing policy. Okay? So what his philosophy was, in a very famous media interview, he said, people will come to the stores because they love the experience. we can just offer everyone an everyday low price, right? And that kind of makes sense, right? So why bother about this kind of discount stuff? I mean, if you just give customers the best price you can all the time, that's a sensible strategy, right? It goes down in history as one of the most epic strategic CEO blunders, right? So JCPenney customers, if you take away their transaction utility that makes people feel smart, when they find deals, what do? They go find it somewhere else, right? It cost JCPenney billions of dollars. It's an MBA case study. It's one of the worst epic strategic fails that actually in existence, right? So what we're getting at here really is about the frame, okay, kind of, so we're talking here about perception and the way we can create different perceptions to get people to behave different ways. So let me show you a way that retailers do this. Now what you can see on your screens there are two deals, right? Now one of these deals clearly sucks, okay, and it's the deal, you should figure out pretty quickly that's a deal on the right, right? So you don't want to pay $8 for that cup of coffee. Yeah, that's right, $8 for that cup of coffee. The question though is, how do we get people to buy that cup of coffee? Okay, and we can do that, right? So as marketers and retailers, Andile, friends, I don't see you, but Andile, you'll like this one. What we do is we add in another option in the middle, right? So what we do here is we change the perception of what the bad deal is. And this is called the decoy effect, right? So by adding in that $7 cup of coffee, what this retailer is basically doing is they're kind of drawing your attention to those two there, and they're making the $8 cup of coffee feel like the good option, right? And of course, when you buy that sort of $8 cup of coffee, you feel smart, right? Because you figured the system out, okay? But of course, you haven't really, right? So it's the retailer that's just making a little bit more money. So I'm going to take you to a very practical example, yeah, because you might say, well, that's great. I mean, this is a hypothetical case. Let's have a look at an actual example from Apple stores, right? So we're going to stick with Apple. I'm going to go through those options there because I'm not sure if you can read that all from the back. But this is from an Apple website, or the Apple website. Deals on 13-inch MacBook Pro computers, right? So on the far left, you can buy a 2 gigahertz processor and 256 gigabytes of storage, and it will cost you $1,499 for that computer, right? By the way, $1,499, that's some psychological pricing because, of course, $1,499 is way less than $1,500, right? In the middle, they're going to add two features. You can now get a touch bar and touch ID, 2.9 gigahertz processor, and 256 gigabytes of storage, and that will cost you $1,799. All the way on the right, touch bar and touch ID is still there. 2.9 gigahertz processor, still there. But now you can get 512 gigabytes of storage, right? And that will cost you $1,999. What's the decoy? Which one's the decoy? Shout it out. Andile, obviously, it's the middle one, right? Well done. He's a marketer. There you go. That's the right answer. Quick as well. So what they're basically doing here, the decoy that they've created is the one in the middle. And it's quite easy to see when you just look at the polar opposites, right? So it's quite difficult to compare those two, right? So the one on the left's got 2 gigahertz processor, doesn't have touch bar, touch ID, 256 gig of storage. One on the right, it's got the extra feature, 2.9, 512. It's going to, if you buy that, it's going to determine by your preferences, right? So if you need the extra storage space or the extra processing power. But by adding the middle option, what are they doing? They're bringing you into the kind of the frame of the middle and the right one, right? Because those are very easy to compare. And now an extra 256 gig of storage, double the storage for $200. So immediately you're drawn to the right? So again, this is just a way that marketers and retailers change the frame, and in changing the frame, change your perception, and actually you leave buying that or fulfilling that transaction feeling smart, right? So transaction utility as well. So as for an economist, there's a thing, it's a thing, right? Transaction utility, right? Because you feel smart. And that is the decoy. Okay, I don't want to talk too much about that. I want to get straight into the research. So how does this relate to the disposition effect? What you can see on your screens now are two states of mind, or two frames, okay? Winning, losing, gains, losses, okay? Green zone, red zone. Now, of course, from a securities trading perspective, what's going to separate these two zones is that blue dot in the middle. Now, that, of course, is what you bought the stock for, right? So prices go up, you go into the gain zone. Prices go down, you go into the loss zone, right? That's going to make you feel a different way. Now, what we can see is that there are two clear emotional biases that get created by this frame change, right? In the green zone, we become regret averse, right? So we become very, very worried that the winning position is going to, in fact, turn into a losing one at some stage. How does that change our behavior? We end up trading too much in the green zone, okay, because we're worried about that position reversing. So we miss out on future gains. In the loss zone, because losses hurt, okay, now you'll also notice that the red block is about 2 to 2.5 times bigger than the green block. And it's simply that way because you'll experience about 2.5 times the dissatisfaction when prices go down than satisfaction when the prices go up, okay? Which basically means that we become very fearful of those losses, so we don't want to realize them, so we don't trade enough in the red zone. Okay, so we don't minimize our losses, we let them run, because we don't want to turn that into an actual loss. Now, the combination of these two things results in the disposition effect, right? People trade too much in the green zone, they don't trade enough in the red zone. And that's what I'm going to show, and this is exactly what the results of our study showed on the Momentum Securities platform. A quick note on how we calculate this, basically. So what we're actually looking at here are the different probability distributions on either side of that blue dot, right? So either side of the purchase price. And we do that as follows. So let's assume that a trader had MMH, or rather in January, bought 100 MMH shares at $15 a share, right? In March, the price dips to $13 a share. The trader buys another 100 shares. In April, as soon as there's a sale transaction on the Momentum Securities platform, we put that transaction under the microscope, right? So we're very interested in what the trader sold versus what she could have sold, okay? Now, in this case, we found that she's actually got some ABSA shares as well. So what happened with the ABSA shares? We find on closer investigation, for example, that the ABSA shares she bought at 160 Rand are now trading at 150 Rand. That's a 10 Rand paper loss per share. She didn't trade on those shares, right? So what she did was she converted 100% of her paper gains into actual gains and 0% of her paper losses into actual losses. Green, red, right? So we look at the probability distributions and we see if, in fact, they are different. If the traders are actually converting more of the green zone trades into actual trades and less of the red zone trades into actual losses. So the results of the study were as follows. Overall, the disposition effect on the Momentum Securities platform is very much in line with international norms. We can see that published research around the globe gives a disposition effect of about 1.3 times to 1.4 times. During COVID, again, guess what? There's a mountain, right? See, all the pictures today during COVID, you either see mountains or like these massive valleys, right? So what happens in COVID? It amplifies those emotional biases, right? So the disposition effect spikes to 1.9 times during COVID. Now, I want to just unpack, just to make sure that we all grasp exactly what this is, just in terms of the diagram, right? So when I say the disposition effect is 1.39 times or 1.4 times, what does that mean? It means that there's 1.4 trades in the green zone for every trade in the red zone, okay? Which means that 1.4 trades out of 2.4 trades took place in the green zone, which means that 58% of trades are taking place in the green zone. Of course, if 58% of trades are taking place in the green zone, it means that only 42% are taking place in the red zone. When the disposition effect spikes to 1.9, it means that there's 1.9 trades in the green zone for every trade in the red zone, right? 1.9 out of 2.9 is 66%, which means that there are now only 34% of trades happening in the red zone. So if we look at the figures 1.4 to 1.9, almost double the amount of trades now are or sort of at least half the trades are actually taking place in the red zone, right? So this just gives an idea of how kind of COVID amplified these psychological emotional biases of regret aversion and also loss aversion. Now, where this gets even more interesting is when we start splitting this up via age group. And I'm going to get to the conclusion shortly after this in terms of what we do with this stuff. So we can see there on the horizontal axis different age groups at the top, right? Starting with Gen Zs, to Millennials, Gen Xs, Baby Boomers. On the vertical axis, we can see the proportion of the population that age group represents. Next line down is the assets under management. Next line down is the trading frequency, the average number of trades per year. last line is the very interesting piece of pre-COVID and COVID disposition effect, right? Let's have a zoom into Gen X's. Gen X's are about 28% of the population. Just incidentally, the study, if you didn't see it sort of flash up on the screen just now, it's about 9 billion rand in trades, 10,000 clients, 2016 to 2021. So a very, very large group of people. Gen X's, 28% of the population, 28% of the AUM, 5.4 times average trades per year, but the interesting part is 1.92 times pre-COVID disposition effect. In COVID, that spikes to 3.92 times, right? 3.92 trades in the green zone for every one trade in the red zone. What that means is a whopping 80% of trades are happening in the green zone, only 20% are happening in the red zone, okay? So again, think about regret aversion, okay? So trading, not trading enough in the green zone, and then not trading, or rather not trading at all, basically, in the red zone. One last interesting difference before we get to what we do with this stuff. So there's also a difference between males and females. So if we look at the overall block there in the far right, we can see that 73%, rather, if we just go back to the left quickly, 73% of the population are males, 27% are females, but the big difference there overall is a disposition effect of 2.04 for males and 1.51 times for females. Okay, so that's about a 30% difference. Now, what makes this quite interesting is if we think about the disposition effect as a combination of two emotional biases, it turns out that males seem to be a little bit more emotional than females, right? There's some uncomfortable laughs, just about a few uncomfortable laughs out there. Now, of course, I mean, we could dig a little bit deeper into this and say, okay, look, well, maybe the males are investing a little bit more aggressively, okay, which may make them a little bit more loss averse. But as we see with the Gen X's, that's a group of people that is extremely loss averse. And then we have a look at sort of the male Gen X's, and we have a group that's even more loss averse, right? So this really kind of takes us to the end part of the presentation in terms of what we do with this stuff, right? So what I'd like to draw your attention to now is, I mean, you would have seen this kind of tagline and strapline, you know, with Momentum Investments, you know, investing is personal with us, right? This is really kind of how this plays. It's not just a tagline. This is the kind of stuff that we do to make sure that it is really personal, right? So there are strategies that you can employ in published research to minimize the disposition effect. And the most popular one, there's a number of them, out there, but the one I'll sort of focus on to end off with is stop losses, right? So research shows that stop losses can increase trading of losing shares by about 115%, so get us to trade more in the red zone, and it can actually decrease trading of shares in the green zone by about 47%, right? And there's a reason for that. So if you set a rule kind of in your head, before you get to an emotional state, if you create a rule, okay, that says 90, like if I buy a share at $100 a share, $90 is my limit, right? If that share goes below $90, I'm out. And you do that before you get into a crisis, you're more likely to actually execute on that trade when the share hits that 90 Rand mark, right? So what happens here is it forces the trade. Remember, you still got to go and execute that trade, but it's getting you into the frame of mind to execute when you reach a certain level. So it's going to increase trading in the loss zone so that your losses don't continue to run. And then what's happening is it's buying you a little bit of psychological insurance in the green zone as well. So you know that even if it does reverse, your position does reverse, you have sort of a floor on the level of losses that you can maintain. And that's, and that psychological insurance gets you to be a little bit more active in trading the shares in the green zone. And this is how you minimize the disposition effect, right? It's one strategy that you can use to minimize this kind of effect. And this really, again, just to close off on, is exactly what we're doing, right? So with us investing as personal, these kind of insights can help us to give clients and advisors insights to help their clients make better informed financial decisions. Thanks very much for your time.
Thank you very much. Wow, the disposition effect. Andre, we learned a new word today, haven't we? All right, we're going to continue using that word as often as is humanly possible. Guys, can we give Paul another big round of applause? That was absolutely incredible. Very insightful how the human brain works. All right, we're approaching the end of our program today, but before we get there, we've got a special guy who's going to come up on stage. We call him FDR. FDR is going to dazzle you with his French accent and baritone voice. So if you're not careful, Francois is going to sum up. Francois Deravel is his actual name, by the way. And he's going to sum up the conversation and tie it up to your advice process. Can we give Francois a big round of applause? There we are.
Thank you, Andile, my number one fan club. Good afternoon to everyone, and thank you very much for attending this, our first hybrid session of 2022. I say hybrid because obviously we've got a live audience here, which is great always, and great to have back, and also our audience at home. So, as our speakers have shared, looking back over the first half of this year, it's been, the financial markets has been what we term as a perfect storm. I think you will agree with it. I've been looking at mine and my own personal things selfishly because of approaching retirement. You're supposed to laugh, but it's not funny. I've been following this very, very closely, and I saw that perfect storm, and I've been feeling every single thing that our speakers have spoken about today. And I'm looking at the people nodding in the audience. My job now is to sum up today and still give you a positive twist. So how's that for a joke? Okay. As a result, it's not surprising that we find ourselves now in a bear market. I think you'll agree on that. Many countries are expecting high inflation levels that are exacerbated by that war between Russia and Ukraine that doesn't end, apparently. Interest rate, and all around the globe at the moment, we're seeing rising interest rate. Our concerns are very real for an imminent recession. So, I mean, not master of doom and gloom or everything. Amid everything that we've discussed, July seems to have rallied a little bit. The markets, the global markets, and ours was not different from that. So what does this mean for you, us, in a conversation with your clients? As the old saying goes, investing is not about timing of the market, but the time in the market. I think to some of you, you've heard that from just about every one of our speakers today. I'm going to actually prove it, because history has shown that those events have occurred before, and they will occur again. A few noticeable ones come in to mind. The Black Monday crash of 1987. Okay, where the dot-com bubble in the year of 2000, the 2005. I'm going to read my note. Check out the back. They're very good. I knew I would mess it up somehow, but no, I'm teasing. No. Some of those facts are very, very important to see. I'm going to show you a slide now, in a few moments, that will demonstrate probably the most, in my opinion, not just because it's mine, but it's possibly the most important slide of the day. So let's have a look at historical market stock patterns over the last few years. This is from Shelby Center for Financial Research, just an acknowledgement to them. Have a look at this. You will find that in the longest, I'm trying to get it on my slide now, one of the longest bear market period was 929 days. Okay? But look at the recovery thereafter, 1,826 days. Each time there's a blip. I don't want to underplay this or underplay what was discussed today. But if you wanted to take a photo, and I'm sure this is going to be sent and it's going to be accessible to all of you. But please use this to discuss it with your clients. As I said, in my opinion, this is a very, very important slide. Look at all the bear markets in red, and look at the recoveries to say about the timing in the market and leaving the market too soon. I heard my colleague Ian talk about cash. Cash has never been trash in my mind. but there's a balance to be had. Because if you disinvest now and go completely into cash, as some of our clients are doing, guess what's going to happen? Okay, you're going to lose out on these opportunities that follow a bear market. Okay? So, moving on, and I'm now going to sort of go a little bit ad lib. I'm not going to repeat some of the stuff done today. Momentum and our MFP Houseview and in-house portfolio. They are there, they are engineered to protect the client, to protect you. It is not a sell, we're in the business of advice. That, I think, must be incredibly clear. We have talked about diversification. It is diversification at every level, being deliberate about diversification. You have seen and heard all our experts. We have the benefit of our team here of experts, and also in consultation with Equilibrium and a panel from Momentum Financial Planning that looks after those house funds and you've seen the diversity and the number of managers that we use. We will continue to work with these partners. They ensure that the funds are invested in the correct asset classes and have exposure to the strategies and specialist managers to get investors the outcome, the appropriate outcome. And what we promise, we will do our best to deliver. Our team remains committed to managing the risk in the portfolios, focus on what you do best, spending your time with your clients, guiding them through complex, and volatility and everything else. It is not easy, but right now, I would say caution and sanity must prevail, if I had to end up. So stick to the predetermined strategy. It's key. And let's not avoid the short-term aims and goals and everything else, and rather look at it on a long-term basis. If I had to sum up, this is me for today. I hope I've captured what you have seen, but I really, really, really will go back to this. I'm obsessed with this slide, because this is the one that I will look at every single day to remind myself, just don't panic, even though there's 2 years left. So, Andile, thank you very much, and thank you to all of you for attending, and our audience at home or in the offices, our virtual audience. Thank you so much for joining us, and we look forward to seeing you in the next quarterly one. Thanks, Andile.
When you have as much money on the line as Francois does, you can't afford to panic. You've got to keep sane. All right. Is it 2 years and counting, Francois? Or are you going to try and push for a little bit longer? We love you. We want to keep you around. Can we give another round of applause to Francois Deravel? All right. Ladies and gentlemen, I also want to introduce a couple of more people as we draw to a close for today. Emily and Rupert. Emily Maoko, she's an OBI fund specialist. She's in the room with us today. She's going to join us for a gin. Please make sure she has doubles only. The singles are finished. But she's going to join us just to extend the conversation further than just the presentations that you've seen today, as well as Rupert Giesing. He's a business development manager for Equilibrium. They will both be with us in the room next door. But for today, not just the two of them, by the way, but every speaker who you've seen on the stage as well. All right, so we can continue the conversations past the presentations. I want to thank you all for your attendance. We look forward to networking with you and the Momentum Investments team. I also want to thank the people at home who've been watching very, very quietly and patiently as we go through quite a lot of information, I believe, but very useful information. But for the rest of us in the room, there will be refreshments, there will be drinks, as I mentioned. It's been an absolute pleasure having you in the room with me today. I hope you've enjoyed the conversations. I hope you've learned something from the conversations. And until next time, remember, the quote that you've just mentioned, Paul, I love it. I tried to memorize it earlier, but I actually should know it. With Momentum Investments, with us, investing is personal. Thank you very much, guys. See you next door. Take care. Sorry, just one more announcement. Please do not forget to swipe your cards as you leave for the CPD points. All right. Please do not forget. Thank you very much.